Good morning. Am I mic'd so that you can hear me?
The microphone working back there?
Yeah, pull it around.
Is that all right?
There,
Thank
you're
you.
good now.
Good. Good morning. I'm Kathleen Roberts-Scarrett, Dean of Arts and Sciences at the University of Richmond, and I welcome you all to this conference. We are delighted to have the Global Interdependence Center staff and fellows with us today to have the second conference of the Global Society of Fellows. It is my pleasure this morning to introduce Paul McCulley, who's chair of the Global Society of Fellows. Paul McCulley received or attained his MBA from Columbia University and went on to a wonderful career where he became a senior member of the investment committee of PIMCO with Bill Gross, a tremendous investment firm. Paul wrote the Global Central Bank Focus research publication on a monthly basis, and that meant that his analysis and observation formed the basis of the very large stakes he would take in the market. So there's nothing like being a fiduciary of other people's money to focus the intelligence on the validity of your conclusions. As such, he became one of the greatest bond traders of his generation, and he has benefited many investors enormously. As a professor of religious studies, I don't really know what a bond is. I just know they have very fancy price tags associated with them when Paul is trading them. So I met Paul in a very different context. I met him as a philanthropist and as a trustee of his alma mater, Grinnell College, where he was a scholarship student in the 1970s. I was an academic dean at Grinnell College, running a rogue operation out of the dean's office. This will scare any trustees of the University of Richmond, where we were students and faculty and one former president teaching courses to incarcerated men and women in 2 prisons in the outback of rural Iowa. No one really approved of this work. Certainly the wardens were not happy to have us, and the administration of Grinnell College was not all that enthused our taking these beautiful young people into these prisons. Why did we keep going? Because we saw the transformation in the men's and women's lives, and because we experienced the transformation in our life. So I met Paul McCulley because we gave a presentation on this rogue operation to the community and to many trustees who were invited, and at the end, Paul McCulley stood up and in honor of the former president made a gift to the operation that had 2 effects. It enabled us to buy gas so we could get out to the prisons and books and other supplies, and it protected us from people who would have otherwise squashed us like a bug. And so that's how I came to know Paul McCulley as someone who reflects not only on how we get and spend, but also how we sow and reap, and how our profound experiences of indebtedness, moral and otherwise, become the opportunities of shared grace. I'm delighted to welcome you to the University of Richmond in Virginia, where it is your home.
Thank you, Kathleen. I guess I'm supposed to call you Dean Scarrett when I'm here, but you're still Kathleen to me, going back to the plains of Iowa at Grinnell. And the program that she was mentioning is near and dear to my heart, and I can continue to be majorly involved in it. In fact, we just have a feature documentary on that entire program that's come out that's named The Gray Area. And that's one of the things I do in my life of retirement is do documentaries. So that's a very cool memory. Thank you. And I think you do kind of understand bonds, just not fiduciary bonds related to money that Jeff and I deal with all the time, but bonds that matter in the humanities. It's a delight to be here in Virginia. I grew up about 100 miles from here in Stanton, Virginia, so it's good to be back to my home state here at the University of Richmond, and also the second annual event of the Global Society of Fellows, which is something that we established a little over 2 years ago at the Global Interdependence Center in Philadelphia. The Global Interdependence Center, or the GIC, was established in 1976. I graduated from college in '79, so it's been around for a long period of time. Larry Klein was deeply involved in the founding in Philadelphia and the Wharton School, going all the way back to that time. And the Federal Reserve Bank of Philadelphia, where we actually have our offices now, has been a long-time, robust supporter of our activities there in Philadelphia. And over time, other regional Federal Reserve banks have become strong and wonderful supporters of our activities, with presidents speaking all over the world for us. And it's delighted to be here with President Lacker and his colleagues, with them sharing this opportunity to explore some issues. What we do at the Society of Fellows is try to move the needle at the GIC towards increasing content. GIC has a long history of having delightful and wonderful conferences around the world, of convening all sorts of players to discuss important issues of our time. And what I'm doing in retirement is trying to get, and so far I think we're doing reasonably well with the Society of Fellows, providing content itself of knowledge base for discussions of topics of our time. And last year was our kickoff, and our model for operation of how we do our original research, I think, is unique in that we try to marry and merge a senior practitioner in the private economy with a star in the academic community, so as that we have work and scholarly research that combines the best of both. Perhaps reflecting my career, I like to have research that has a degree of practicality to the real world, as opposed to getting published in journals that nobody reads. I understand that game. However, I don't want to play that game. I want to have that, I want to harness that level of scholarship into the real world. And marrying a practitioner and an academic star together is a cool way of doing that. So that's the framework that we work with the Society of Fellows. And interestingly enough, people ask me, well, how do you pay for all this? Well, we're an endowed society, but also the senior practitioners who become fellows, and we'll be announcing 2 fellows in a moment. The senior practitioner in the field is actually very much giving their time, their energy, and their labors. And it's an enduring appointment once you become a fellow. And then each year we pair up the academic as a visiting scholar. And actually there's a stipend going with the visiting scholar, which is kind of cool, that the visiting scholar gets a stipend and the practitioner actually is strictly on the giving side. But it works really well, I think, so far. And the theme that last year we had was reevaluating orthodoxy in unorthodox times. In particular, my particular area of scholarship is liquidity trap economics. And how do you look at the separation and the independence of monetary and fiscal policy in liquidity trap conditions? We were at the Central Bank of France. I did a major paper in that space. our other beginning fellow, John Sylvia, did a major paper on the implications for income distribution of extraordinary monetary policy, which was a very nice paper done with two rising stars in the academic space, including one from William and Mary, just right down the road. And I was actually have learned that I didn't need to have a major paper on this. I could just talk to my 80-year-old mother. She has very, very strong opinions about income distribution implications of unorthodox monetary policy. She doesn't call it that. She just says, son, I cannot live on these CD rates. But it's the same sort of a concept. So that was last year. This year, we're continuing in the same theme. As you can see, is the issue, if we are in a liquidity trap, have enduring long-term unemployment that seems unresponsive to cyclical fine-tuning of our economy, should we re-explore the notion of public investment? For much of my career, public investment was considered to be an oxymoron on Wall Street. You cannot have public investment. You can have public waste and fraud. You can have private investment, but the notion of public investment, we don't put those in the same sentence. Well, I'm putting them in the same sentence, and we have two absolute wonderful papers today applying that concept in two different spaces. One, at the cutting edge of where we are in the automotive industry, which combines a huge amount of analytical approaches, but celebrates the notion that a public good and therefore public investment does exist in that space. And then our second paper this morning will be along the same theme, and I think will be more provocative and more contentious in some respects, is the notion that if a liquidity trap involves an overhang of private debt, and it does, if a liquidity trap involves an overhang of private debt, is there scope for private sector debt forgiveness under the architecture of public investment? And combining the best or the worst of two disciplines called economics and law. So we had treats this morning on these the two topics, and then this afternoon I will speak on a paper that I've recently done, and our colleagues from University of Richmond will wrap up the day reflecting on what we learned. So it should be a fun and interesting day. Let me kick things off here now with a short little ceremony, and then we will have Dr. Lacker discuss the interaction of a whole bunch of things in public space, private space, and legal space. So Ellen and Richard, if you can come forward. And Jill, you got a camera. And Jeff, we need you here as well. Got to remember that I'm not allowed to use first names, even though I've reached a certain age where I want to. I can carry this room. Ellen, it's absolutely delightful to have you join us as a fellow of the Society of Fellows of the GIC. And let me give you your official induction certificate. Richard, it's absolutely wonderful to have made your acquaintance in recent years and to actually now share your scholarship with our endeavor. And we give you yours. Thank you. And thank you for being here at this moment with us. We really appreciate it. Thank you very much. Congratulations, Ellen. And thank you. And if you can get a picture here, you got a picture of us. This will be on our website, obviously. This is cool stuff. I like pictures the older I get.
Yep, move down a
A little bit. There we go.
Away from the door.
Away from the door. That's a good thing.
Okay, ready? 1, 2, 3. Hold here. Richard, would you mind holding up your certificate a little bit? Ellen's doing a great job. Okay, great. Thank you very much. Wonderful.
Thank you.
Thank you.
And Jeff, you want to get your paper? Congratulations. The introduction for Jeff is actually in your brochure. I think everybody here in this town knows Jeff. You're on. Great. How's that? I don't want to take any more of your time. You're on.
All I need. I'm going to close the lid on this and let whoever follows me deal with the consequences. Never know whether to close the lid on a laptop or not.
That's called an externality.
There you go. Well, let me start by welcoming the Global Interdependence Center and the Global Society Fellows to our wonderful town, Richmond, Virginia, and thanking the fellows for inviting me to speak here today. I have a long history of engagement with the Global Interdependence Center, stretching back to a visit we made to Israel in November of 2008. And that was an interesting time to be out of the United States, as you might well imagine. So my topic today concerns, to some extent, in a loose sense, public investment. It concerns the relationship between the private sector and the public sector, in particular the financial sector and the public sector in the United States. So the financial crisis of 2007 and 2008 exposed some fundamental flaws in that relationship. And we've seen a wide range of reform proposals ever since then. A number of these proposals were considered as part of the debate leading up to the Dodd-Frank Act, the financial reform legislation of 2010. But some of the proposals actually, found their way into the act. But that didn't stop the debate. That didn't put an end to the discussion of the relationship between the financial sector and government. Indeed, there have been an array of proposals that have garnered attention in recent months, ranging from breaking up the large banks to expanding existing government backstops to a broader range of financial market activities. So even though a number of ideas have been put forth, there appears to be a widespread agreement among participants in these discussions, and that is that we end too big to fail. So this morning I'm going to talk about what I think we need to do to end too big to fail. And as always, I need to preface my remarks with the reminder that the views expressed will be my own and not necessarily shared by any others in the Federal Reserve System. The standard disclaimer. The phrase too big to fail has become something of an all-purpose descriptor of the problems afflicting financial markets in the U.S., but it's a bit of a misnomer, and it's because of the multiple meanings in this context of the word failure. Now, you might think of failure as protecting a firm's shareholders from losses. Now, the incentive problems that are associated with the phenomenon we call too big to fail really, though, stem more from the protection of the creditors of the firm, not the shareholders. So a firm could fail in the sense that its equity is wiped out and the management of the firm is removed. But if creditors expect some government support to flow to the firm, and that support to be used to limit the losses that creditors would otherwise suffer, then their incentives to avoid risk, their incentives to ensure that the firm is managed carefully are going to be severely depressed. Now, a firm with that kind of implicit support can borrow at relatively inexpensive rates, and it's going to be more highly leveraged, and it's going to be more fragile and vulnerable to shocks than it otherwise would be. This is the basic moral hazard problem with government guarantees, but it flows, it's important to note, not through any particular implied guarantees to shareholders, but through implied support for the creditors of the firm. So let me be clear here, and any speech about too big to fail ought to start with, pretty close to the beginning, some sort of definition of too big to fail. Broadly speaking, too big to fail consists of two mutually reinforcing problems. The first is that creditors of some financial institutions feel protected by an implicit government commitment of support if the institution should become financially troubled. And the second is that policymakers often feel compelled to provide that support to certain financial institutions to insulate creditors from losses. So it's two mutually reinforcing problems. Instances of intervention reinforce creditors' expectations of support, and they encourage creditors and the firms they're invested in to rely on highly liquid means of funding themselves. And those means of funding themselves through liquid securities, liquid instruments, actually make that support more likely. Creditor expectations that they're going to get supported force policymakers to intervene in the event of distress, because disappointing those expectations of support by withholding support would provoke a sudden and very turbulent readjustment of investor expectations regarding the likelihood of support for other similarly situated financial institutions. And this is the dilemma. This is the other side of the mutual reinforcement. And people are familiar with the sense in which, the instances of support reinforce expectations of support, but the fact that creditors expect support forces policymakers' hands in a crisis, because if you don't provide it, then creditors are going to pull back from a range of other similarly situated institutions. So I'm in an academic setting. I'm going to use the word dialectic, although it's been a while since I've read my Hegel. So the dialectic goes like this. Perceived guarantees encourage fragility, and fragility induces intervention, and that just encourages further fragility. The result is seriously distorted incentives to monitor and control risk, and taxpayer-funded subsidies to financial firms that are widely viewed as deeply unfair. So to end too big to fail, we need to bring about two mutually reinforcing conditions. The first is that creditors do not expect government support in the event of financial distress. And the second is that policymakers behave in a way that's consistent with that expectation, specifically by allowing financial firms to fail without government support. If we can achieve that commitment and make it credible to financial market participants, we can improve private sector incentives to avoid fragile financing arrangements and to limit risk-taking, and we can thereby reduce the pressure for government intervention. So it's important to note at the outset here that allowing a financial firm to fail without government support for creditors does not mean that the operations and activities of the failing firm will simply grind to an abrupt halt. Outside the financial sector, most firms, and even relatively large ones, fail by filing for bankruptcy and thereby initiating a court-supervised set of procedures to either restructure their obligations or continue operations and liquidate assets and distribute the proceeds to creditors. If it proves more valuable to creditors collectively to continue the firm's operation as a going concern than to liquidate, bankruptcy provides an orderly mechanism for doing that. Indeed, several large airline companies have gone through bankruptcy organizations while continuing regular flight operations. So, a key provision of the Dodd-Frank Act, it's in Title I, Section 165D, in fact, requires that bank holding companies larger than $50 billion in assets, as well as certain non-bank financial companies, draw up detailed plans for their orderly resolution in bankruptcy without government assistance and submit those plans to regulators. In my remarks, I'm going to be discussing the work currently underway on those resolution plans. These are known as living wills. And I'm going to argue that resolution planning represents the most promising path towards ending too big to fail. Indeed, I believe that without robust and credible resolution plans, other financial reform strategies are likely to be incomplete and to fall short. So much of the financial reform agenda since the crisis has focused on enhancing the supervision of large financial institutions with the goal of reducing the probability that they actually experience financial distress. For example, regulators have implemented enhanced capital and liquidity standards for so-called systemically important financial institutions. Through the capital stress test process, regulators regularly assess whether firms' current and planned capital positions would prove adequate under plausible adverse scenarios. These and other supervisory enhancements are really essential to containing moral hazard and improving financial stability. I endorse them wholeheartedly, and I would note that Chairman Bernanke gave a speech last night focused on the capital stress tests that I just alluded to. So capital levels at U.S. financial firms have improved dramatically since the crisis. Some critics argue that capital requirements should be increased even further. that we need higher capital in order to make banks safer. Higher capital ratios, obviously, all else held constant, would reduce the probability that a financial firm incurs losses large enough to make it insolvent. But one clear lesson of the financial crisis, in my view, is that capital ratios at the large firms were inadequate. So I endorse efforts that we've undertaken so far to increase the capital ratios of those institutions. But another lesson of the financial crisis is that we need some attention as well to what happens in the event that a large financial institution does become insolvent or close to insolvent, as rare as that event might be. Once a firm's capital is eroded, the fact that it had higher capital before it was hit by a shock is of little comfort. So remember now, the complexity of modern financial firms and the resulting apprehensions about the consequences of their unassisted failure is really what motivated a wide array of government and Fed actions taken during the crisis. And anticipation of those responses can have powerful incentive effects in normal times, even if it's a low probability event. I think it's unlikely that we're going to raise capital levels high enough to completely eliminate the possibility of financial failure for a financial firm. And because of that, I think it's essential that we be prepared to handle such failures should they occur. Now, some observers have argued that the problems associated with resolving a large and complex financial institutions have largely been addressed. In particular, they point to the Federal Deposit Insurance Corporation's authority under the Dodd-Frank Act, the Orderly Liquidation Authority. And they point to this as a credible mechanism for resolving financial firms without bailouts. This is a portion of the Dodd-Frank Act. It's in Title II. In fact, Title II is entirely given over to this. It gives the FDIC the authority, with agreement of other financial regulators, to take a firm into receivership if it believes the firm's failure poses a threat to financial stability. Many provisions of Title II mirror provisions of the Bankruptcy Code, and in winding down a firm under the Orderly Liquidation Authority, the FDIC is guided by what various claimants would be entitled or estimated to receive in a bankruptcy proceeding. But the FDIC does have the ability to deviate in some important ways from what might occur under bankruptcy. In particular, it can make payments to creditors it deems necessary, and it can draw funds on the Treasury to do so. Indeed, the FDIC has announced its willingness to do so in some circumstances. This ability and the willingness of the FDIC to do it opens the door to creditors believing that they might benefit from such treatment, and therefore, as before, to pay less attention to risk than they should. If expectations of support for financially distressed institutions in orderly liquidation becomes widespread, then regulators would likely feel compelled to provide support again in a crisis simply to avoid the turbulence of disappointing expectations. And we will have replicated the two mutually reinforcing problems that define too big to fail. So this feature of the implementation of Title II, that it recreates the capabilities and incentives that originally gave rise to excessive government rescues, motivates the view that more needs to be done in order to truly end too big to fail. Many recent proposals to address the problem would make structural changes to financial firms, imposing quantitative limits on their size, for instance, or prohibiting certain risky capital market activities. In my view, it makes perfect sense to constrain the scale and scope of financial firms in a way that ensures that they can be resolved in an orderly manner without government protection for creditors. But how would you know you have chosen the right limits? Is size alone the issue? And if so, how small would you make them? If activities are the problem, which ones make it hard for them to be resolved? And how do you know you haven't gone too far and sacrificed valuable efficiencies that may derive from the current industrial organization of the financial system, the scale and scope economies that have brought us so many benefits in the financial sector? The only approach that I can envision to answering such questions is resolution planning. That is, the hard work of mapping out in detail just what problems the unassisted bankruptcy of a large financial firm, as it's currently structured, might encounter. Such maps would provide an objective basis for judgments about how the structure or activities of such firms need to be altered in order to give policymakers the confidence to choose unassisted bankruptcy in the event of default, but without going too far and unnecessarily eliminating efficiencies associated with economies of scale and scope. In addition, the process of writing credible living wills would illuminate efforts to identify ways in which the bankruptcy code could be improved to make the resolution of financial firms more orderly. So the Dodd-Frank Act requires that bank holding companies larger than $50 billion in assets, as well as non-bank financial companies supervised by the Fed, submit resolution plans annually to jointly the Federal Reserve and the FDIC. A final rule implementing this provision was announced by the Fed and the FDIC in October of 2011. A plan or living will is a description of the firm's strategy for rapid and orderly resolution under the U.S. Bankruptcy Code in the event of material financial distress or failure. It must contain a description of the firm's organizational structure, key management information center systems, critical operations, and a mapping of the relationship between core business lines and legal entities. And that's important because for modern financial firms, often core business lines cut across operations of various legal entities. The heart of the plan is a specification of the actions a firm would take to facilitate rapid and orderly resolution and prevent adverse effects of failure, including the firm's strategy to maintain operations of and funding for material entities. Firms are required to provide analysis under 3 economic scenarios, the ones stipulated by the board for the capital stress test analysis that I alluded to earlier and that Chairman Bernanke spoke about last night. There's a baseline, there's an adverse scenario, and there's a severely adverse scenario. Plans may not rely on the provision of extraordinary support by the U.S. government, including by the Federal Reserve. The Federal Reserve and the FDIC can jointly determine that a plan is not credible and would not facilitate an orderly resolution under the Bankruptcy Code, in which case the firm is required to submit a revised plan to address identified deficiencies. A resubmitted plan could include plans to change the current business operations and corporate structure in order to eliminate those deficiencies. And if the Fed and the FDIC jointly determine that the revised plan does not address identified deficiencies, they can require higher capital, tougher liquidity requirements. They could restrict the growth, activities, and operations of the firm. In essence, regulators can order changes in the structure and operations of a firm now to make it resolvable in bankruptcy in the event of financial distress without government assistance. Regulators last year required the first round of submissions from the largest U.S. firms and foreign-based companies with significant U.S. assets. These plans reflect considerable effort by the covered companies to address requirements of the resolution plan rule. Through the process of developing the plans, firms deepened their understanding of their own structure and operations, as well as vulnerabilities that may arise in resolution. These plans have provided improved insight into the workings of the firms, including their complex legal entity structures, financial operations, and operational interconnectedness across different affiliates, and those critical operations that are crucial to financial stability. These insights are being used to enhance supervision more broadly and to promote industry best practice. The process of constructing a set of robust and credible living wills must be iterative. Because of the magnitude of the planning efforts required, it made sense for a streamlined set of requirements for the initial round of submissions. For example, firms were asked for analysis in the first round of just one of those economic scenarios rather than all 3. First round submissions have provided valuable lessons learned, both for covered firms and for supervisors, about areas where further analysis is needed. Regulators intend to provide feedback to those firms to help guide subsequent rounds of submissions. And over time, our collective understanding of how the unassisted resolution of a large financial entity works is going to deepen. Armed with that understanding, we can bolster policymakers' confidence in the plans through appropriate preparations, including structural changes in the nature and organization of the business operations of financial firms. This confidence can move us closer to the day when the bankruptcy is as much a non-event in finance as it is in the airline industry. Several critical challenges must be addressed, however, for the Living Wills project to succeed. One relates to globally active financial firms with interdependent entities in different national jurisdictions. Achieving an orderly resolution of such a firm can be difficult because regulatory authorities in different jurisdictions may be concerned primarily with the continuity of operations and the taxpayer impact in their own country. One approach to this problem is to require globally active firms to form distinct legal subsidiaries with separate capital and liquidity holdings to conduct their material overseas operations so that they can be resolved separately in the event of financial distress. The ability to expeditiously sell material foreign operations would provide valuable flexibility and would obviate dependence on cross-national negotiations about inter-affiliate movements in capital and funding in the event of financial distress. Widespread use of subsidiarization, as it's called, could well impose additional operational costs on such firms or limit their ability to shift capital freely among affiliates in normal times. But if subsidiarization is what it takes to make a resolution plan credible, then the resulting burden, the magnitude of the resulting burden to financial firms, should be viewed as a measure of the subsidization attributable to their status as too big to fail institutions. This is a good example of the types of trade-offs and insight that the Living Wills work is going to help us understand. Subsidiarization, as it's called, has potentially broader uses in the preparation of living wills. One simple approach to resolution is for the highest level parent organization to file for bankruptcy, treating all the domestic affiliates as part of a single going concern. And this parallels the FDIC's announced intention to handle resolution under its orderly liquidation authority through so-called single point of entry. They deal with the parent level entity, not any of the other subsidiaries. They interact with the parent and take that into receivership rather than taking all of it into receivership. At the same time, however, I think we need to devote ample attention to being able to sell off significant subsidiaries as standalone entities when it might make good economic sense. This might mean investing ahead of time in distinct operational infrastructures or in writing service agreements, legally binding service agreements between the affiliates that would survive the bankruptcy of one or more of the affiliates. And so service provision could continue to go on. We should not assume that all hands go down with the ship, as in a single point of entry scenario, when preparing sturdier lifeboats might make sense. Perhaps the most critical challenge for resolution planning concerns funding. The U.S. Bankruptcy Code allows bankrupt firms to obtain, subject to court approval, debtor in possession, or DIP, D-I-P, debtor in possession, DIP financing that is generally senior to pre-existing creditors. Such financing can be useful to fund ongoing operations, for example, to pay off certain creditors, for example, vendors, rather than retain the vendors in bankruptcy and make them go through the proceedings with everyone else. Other creditors often find it advantageous to approve DIP financing, even though it's senior to their own claims and thus dilutes their own claims, because it ensures continued access to trade credit that's useful for the ongoing value of the concern. The FDIC's authority to lend to distressed institutions under its orderly liquidation authority amounts to government-provided DIP financing. The beneficial feature of privately provided DIP financing is the presumption that because it's provided by market participants, but also approved by creditors in the court, it's fairly priced and thus unsubsidized and does not unduly disadvantage any one creditor class. Indeed, this is why unassisted bankruptcy is so crucial to ending too big to fail, and it's why firms were prohibited from assuming extraordinary government support in their resolution plans. For large financial firms, creating a credible funding plan that avoids adverse effects without resorting to government DIP financing might seem daunting given the scale and the limited observed size of private DIP financing that we've seen to date. I think the Biggest one we've seen to date in the private sector was $8.9 billion for Lionel. The scale of a firm's potential liquidity need would, however, be heavily influenced by how it manages its liquidity prior to experiencing financial distress. And just as operational obstacles to orderly resolution can be remedied by reorganizing operations ahead of time, funding challenges that would otherwise arise in bankruptcy of a large financial institution can be contained through appropriate changes to liquidity management in normal times. Indeed, this is consistent with the broad strengthening of liquidity management we've seen since the crisis. Now, one might worry that the changes in liquidity management required to render a resolution plan credible without government-provided DIP financing might squelch socially beneficial maturity transformation. This is lending long and borrowing short, providing liquid liabilities while holding illiquid assets. One should also be concerned, however, that too big to fail has resulted in socially excessive scale of maturity transformation because the associated fragility is more likely to elicit government support to protect creditors than intermediation that does not involve maturity transformation. In my view, the latter should be our dominant consideration in the wake of this crisis. So in conclusion, let me say it's vitally important that regulators work together to ensure the adoption of robust and highly credible resolution plans for large financial institutions. Financial industry also has an interest in ending too big to fail and thereby strengthening reliance on market discipline because the alternative to ending too big to fail implies an ever-expanding blanket of safety and soundness regulations that threatens to smother the ability of the financial sector to offer useful financial products and services. The Living Wills program will require a great deal of hard work and detailed analysis, but I see no other way to reliably identify exactly what changes are needed in the structure and operations of financial institutions to end too big to fail. I see no other way to achieve a situation in which policymakers consistently prefer unassisted bankruptcy to incentive corroding intervention, and investors are convinced that unassisted bankruptcy is the norm. Credible living wills may require significant changes for financial firms. They could lead to more capital, less complex relationships among affiliates, and perhaps even to smaller firms. But too big to fail is unsustainable. Ambiguous implied commitments induce fragilities that in turn induce intervention that expands implied commitments. Richmond Fed economists have estimated that at the end of 1999, about 45% of the financial sector's liabilities in the United States were explicitly or implicitly government guaranteed, 45% in 1999. At the end of 2011, as a result of the precedent set during the crisis, they estimated that figure to have grown to 57%. This fraction is likely to continue to grow unless we can end too big to fail. And to end too big to fail, we need to do the hard work of learning what it takes to make all firms safe to fail without government rescues. Thank you, and that concludes my remarks.
As I advertised earlier, we're going to have our newly inducted fellow lead us off here with a discussion. You can see, obviously, the theme, and she will, and her colleague will be presenting, and then right after they present, we will have Santiago do a academic-style discussant role, and then we'll open it for Q&A. So we'll have 3 speakers here from the podium, and I'm looking forward to shutting up and listening. Ellen, come on up.
Okay, good morning, everyone. Thanks for coming. I've got to say thank you to the GIC, the Global Society of Fellows, Paul's leadership. I think it's exciting to have an opportunity to talk about public investment and why it's important. This is a nuts and bolts paper. We are not about derivatives. We are in the physical world, and this paper is a demonstration of, a no-brainer so to speak, because there is so much happening in our future with regard to sustainability and innovation. And if we aren't part of it, we will be eaten by the rest of the world. So I think this is a paper that demonstrates the theme of the conference in the physical world. This is like I said, something that is very supported, I think, and intuitive. So let me just start with a couple of key introductory remarks, and Joshua, the research scholar, is going to take you through some of our assessment and how we did the research. First off, we need good fiscal policy in any global setting, and by that I mean that regardless of whether or not the country may have what some analysts consider to be too much debt or are compromised by other fiscal policy or political features, there still is a way forward to have good fiscal policy. And you can see here, we're not just talking about the U.S. Most major markets use some form of public support to achieve these expansions in infrastructure. And there is an important role for public investment to support that. And then the last key point here, tying it back to job creation and manufacturing retention rates. And this is a theme that I think we in the U.S. may have lost the plot a little bit in the complacent era of the 80s and 90s when we had two long back-to-back expansions. We somehow forgot that the rest of the world was innovating and expanding, and recognized that you get to a critical threshold where your manufacturing sector falls below a certain level and a lot of other activity in the economy falls by the wayside. And I include in that R&D in particular and other innovation. So I think that that's an important element of why public investment is important, to support that and provide a fundamental anchor and foundation for the economy. There's a lot of convergence of public finance principles, policy, and politics in this paper, hidden in some respects between the lines. We need to be working toward a sustainable future. It's important to support energy security independence. We have to be competitive. If we aren't building infrastructure, innovating, and supporting these new industries that are going to be growing, we will be left behind. And I'm speaking specifically about the U.S., not China. And as I mentioned, innovation. So I think those are all critical features of why it's important to support this kind of activity. Now, let me turn to what some of the mobility attributes are in the future and why this support's critical. By taking China as an example, and many of you may know that the central government goal is to get to 5 million so-called new energy vehicles, NEVs, by 2020. Now, that's a cum sales by 2020. So that'd be total NEVs in operation by 2020. And you may know that the Obama administration also has a similar very ambitious target by 2015. For the government in China and the leadership, reduction in pollution is a top priority. There are environmental scientists, particularly at Tsinghua University, that estimate that 20% of the particulate matter comes from the transport sector. So 80% comes from other activities in the country. And then within that, about 60 or so percent of the bad stuff coming out of the tailpipe is related to these so-called yellow label commercial trucks, that they're they're trying to incentivize to get off the road. But that's just a piece of what the leadership in China will be attempting to achieve. They're already at 50% of their domestic needs as imports for oil, and at the current pace, there are estimates that suggest they'd be up to 80% by 2020. So they are working vigorously to pursue this a pillar goal. And when the central government announces a pillar goal, everybody in the world should stand up and pay attention. They are working arduously to figure out how to develop the technology and infrastructure. For example, they have demonstration stations already in place, which are somewhat modeled off the Better Place model of battery switching. So you go to a station, and for an electric vehicle, a robot in 3 to 5 minutes will switch out the uncharged battery and switch in the charged battery, which allows for a efficient way of getting a little more range given the current battery technology. Not what it might be in 2020, what the capacity and innovation could be, although, you know, Kim Hill, who's here from the Center of Automotive Research, has acknowledged that there's been a lot of effort to innovate on battery charging capabilities, and we're still not there. So that's underway right now. CNG options for taxis, buses, and heavy trucks, they're working on quite a bit. There are some regions in China that have a lot of natural gas, particularly around Chongqing. So this is another option that will allow them to achieve their goal. And these NEV initiatives have a common characteristic of reducing particulate matter and greenhouse gas emissions. If any of you have been to China recently, you will quickly understand why this is an imperative. I've just noticed over the last several years the deterioration in Shanghai air quality, which is a more recent phenomenon. And, you know, Guangzhou, Chongqing, these cities are struggling in terms of getting to a better place in terms of the pollution and emissions. So very important kind of case study. Now, with that introduction, I'd like Joshua to take you through his research in terms of what does it take to get to a point where we have infrastructure building out that could facilitate the demand for alternative fuel vehicles. So he's going to come up now and take us through that part of the paper. Joshua?
Thanks, Ellen. First, I just wanted to, clarify which fuels we focused in on. There were 4 that we looked at more closely in this paper. Those include compressed natural gas, ethanol, electricity, and hydrogen. So while compressed natural gas is a fossil fuel, when used in vehicles, it does lead to an emissions reduction for greenhouse gases as well as some other pollutants. It requires larger tanks for the vehicles, and upfitting vehicles is rather expensive. So CNG vehicles on the road today tend to be part of fleets, and as Ellen mentioned, frequently used for taxis, buses, work trucks. Compressed natural gas vehicles have been on the markets in the 3 regions that we look at specifically, which are the United States, Europe, and China, for more than a decade. And in the United States, sales have been up and down during that time, but 2012 was the greatest year for compressed natural gas vehicle sales, so that could be a sign of an improvement in that market. In Europe, some areas of Italy and Germany have quite strong sales in those areas where the infrastructure has already been built out. And as Ellen mentioned, some of the major cities in China are changing over their taxis and heavy trucks and buses over to compressed natural gas. Ethanol is popular mostly in the United States and Brazil. In the US, all regular gasoline is actually 10% ethanol. You may have heard about the controversy over increasing it to 15% content. That could cause some problems with certain vehicles. We also sell in the United States ethanol in the form of E85, which is 85% ethanol, 15% gasoline. That can be used in only specialized vehicles called flex fuel vehicles. Brazil's flex fuel vehicles can run on E100, 100% ethanol. And even in their normal gasoline, they blend in 20 to 25% ethanol. Another fuel is electricity, which many areas around the world have seen infrastructure for electricity spreading pretty dramatically over recent years. As an example, the DOE's database that they keep of charging infrastructure, in November 2010, it had about 600 charging facilities. As of March this year, that number was 7,000. So we've gone a long way in the last few years. And electricity, it has no tailpipe emissions. From a life cycle perspective, depending what kind of power plants you're using, it could have maybe a minor improvement over gasoline, or if you're using more renewables, nuclear power, hydroelectric power, it could have a pretty significant advantage over gasoline. Similarly, hydrogen vehicles have no tailpipe emissions except for, of course, water. Again, also it depends how you produce the hydrogen. It can be produced using steam methane reforming, which takes natural gas and pulls out the hydrogen to create fuel. It can also be created through a more expensive currently method called electrolysis, which pulls hydrogen out of water. And if that were done using renewable energies, you could also see some great reductions in emissions. And so now I'm going to go through the actual analysis that we did. So when you're looking at trying to figure out how many stations that one would need across these three regions that we decided to look at, some methods use the vehicle network and the range of a vehicle to try to figure out, well, how can I build a continuous network such that you can get from point A to point B and provide that coverage. Some other methods look more at estimated consumption of fuel and just saying, well, if we have X many vehicles, how much fuel are we going to have to supply those vehicles, and how many stations are going to be able to supply that amount of fuel. And due to information concerns, we decided to use this second method. And one great example of an actual regulation that uses the second method is the California Clean Fuel Outlet Regulation. And so right here, the top equation I have there is a simplified version of the equation they use to determine how many stations they will require for each type of alternative fuel. And they do this to ensure that these alternative fuel vehicles actually are able to refuel. And so basically they just take that top bit there is fuel demand divided by the average assumed throughput per station to get the number of stations required. Fuel demand is estimated by saying the average distance that a vehicle's going to travel during a year, multiplied by the number of vehicles, divided by the fuel efficiency. So we rewrote that equation in terms of vehicles per station, and that's what you can see on the bottom there. We calculated out mile per gallon equivalents for the four technologies we were looking at using EPA data on 2012 and 2013 models. We made assumptions on the average fuel volume per station based off of some of the assumptions in the Clean Fuels Outlet Regulation, as well as other information available to us about the capacities of various stations. and then we assumed that the average vehicle miles traveled was around 15,000. So using those assumptions, you can see in this table how many vehicles are supported for each station. I also did this for gasoline to give sort of a comparison, and then that resulted in the projected value of 540 vehicles per station. But for the US, we can actually compare how many vehicles per station. So if you take the approximately 240 million vehicles and divide them among the 160,000 gasoline stations, you get approximately 1,500 vehicles per station. So you can kind of see that these values that we're getting from our California clean fuels regulation are fewer vehicles per station, and that's what you'd expect, and maybe even what you'd want in the early stages before these vehicles have, had broader penetration in the market. So, given our vehicles per station estimates, we were able to then create an estimate of how much infrastructure cost per vehicle would be. We used estimates of adding capacity for these various fuels to gas stations, and you can see those in the top table on the slide. We looked at a few other studies which had attempted to do the same thing. So there was a National Petroleum Council study, as well as a study from the National Academy of the Sciences. Our estimates fit fairly well in between the NPC study estimates, as you can see compared to the first and second tables there. And they're similar in many ways to the estimates from the National Academy of Sciences. A couple things that we did a little bit differently are for the CNG vehicles and the plug-in electric vehicles, which we lumped together, the battery electric vehicles and the plug-in hybrid electric vehicles, because for either of those, if you're going to own them and actually get any value from owning those vehicles, you have to have charging infrastructure, otherwise you're just driving a very expensive gasoline-powered car. So for natural gas and electric vehicles, we added in home charging station costs of $500 for a natural gas one, which currently GE and Eaton are independently working to create such a station. And for plug-ins, we assumed $2,000, $1,000 for a level 2 charging station, and $1,000 to install the type of outlet, the specialized outlet that's required for that station. And so the next part of our study went on to looking at, in the 3 regions that we were examining, what sales might look like in 2030. In order to do this, we took forecasts from LMC Automotive, supplemented by other government and industry organization data for these countries, to take those forecasts and use a linear trend line out to 2030. So the LMC data, the LMC forecast goes through 2022, and we just took a linear trend out to 2030. And we ended up at this distribution. For hydrogen, LMC did not have any sales in China by 2022, so we did not include that. In addition, we were unable to find reasonable information on flex fuels in China, so those were also not estimated. Sales in Europe, we calculated to be a little under 10%. In the US, over 17%, but the vast majority of those are flex fuel vehicles, most of which, if driven the way they are today, will run on gasoline rather than ethanol. And so if you excluded those, the US would drop down to below 3% of these types of vehicles, and then China at over 6%. So now I'm going to go through sort of country by country and show you the trajectories of that we used for this research. There could be a lot of variability on these projections. You could have changing adoption rates, you could have a technology breakthrough, you could have changes in government support. So all of those things could make these lines, move pretty dramatically. But we think that these lines are, fairly conservative and show at least a central tendency of where these vehicles are going. So you can see in Europe that plug-in electric vehicles are, almost at 1.5 million vehicles by 2030 in Europe. Compressed natural gas over 1 million by 2030. And flex fuel and hydrogen are just, still a very small portion of the market. In fact, I think hydrogen sales weren't forecasted to come online until maybe 2018, and even by 2030, that's maybe about 5,000 vehicles on there. So moving to the United States, again, you can see flex fuel is the largest portion of sales. In recent years, we've been selling between 1 million and 1.5 million in vehicles. I read in an article just maybe a week or two ago that in the United States, approximately 2 million flex fuel vehicles were produced last year. So moving from 1.5, 2 million to 3 million, over the course of this time period is not that huge of an endeavor. Then you see plug-in vehicles coming in at 500,000, and hydrogen and CNG having relatively low trajectories for this time period. In China, again, we only looked at compressed natural gas and plug-in electric, but plug-in electric by 2030 is 1.5 million, and CNG is more than 500,000 vehicles per year by 2030. And so we wanted to create some sort of calculation of what all the vehicles in operation would look like. So we assumed that vehicles would last approximately 13 years. That's a fairly common vehicle life. So we added up the last 13 years of data from 2018 to 2030 to kind of get these proxies for how many vehicles might be on the road in these various countries. So you see, over 20 million of these vehicles in Europe, 35 in the United States, and 15 million in China. And so those numbers initially that I brought out on cost per vehicle, we applied those to the fleet numbers. So our study kind of implicitly assumes that there's no differential inflation or exchange rates, no technology cost reductions, and this is sort of just a steady state estimate of cumulative spending over the years up until 2030 for these markets. So you see, while the United States had the most alternative fuel vehicles, because ethanol stations are so inexpensive comparatively to install, they actually have the lowest required investment at under $19 billion. But across the three countries, you can see that $95 billion in investment will be required by 2030. But that doesn't take into account investments that have already occurred. So we went ahead and found sources estimating the number of stations in each of these countries and multiplied those stations, because we couldn't find actual spending data on all the stations, multiplied them by the estimates that we used for our initial model to differentiate between past spending and future spending. So even netting out what our estimate for past spending was, there's an additional, we've spent $8 billion so far, but we have an additional $87 billion to go. And that's all in current US 2013 dollars. And so now I'm going to hand this back to Ellen, who's going to conclude with some remarks.
Okay, thank you, Joshua. That was great, and I want to emphasize that this is a hard calculation to make because of the way that technology is disruptive. So that we projected out a trend for all those alternative fuel vehicles, recognizing though in a very sober moment that, if there's a policy intervention or if there's a consumer choice that emerges, let's say with CNG, because of our energy boom, let's say here in the US, that technology could really take off. So, think of each of those projections as there's a range around that central tendency, but substantial, possibility of disruption. And, frankly, I'm thinking about who's going to criticize this sort of assertion that we're making about the need for public investment, one of the criticisms would be, well, for goodness sakes, you know, you're going to spend all this money, it's going to be totally inefficient because you're going to have stations for battery electric vehicles and there's not going to be any demand. Well, you know, I guess as an economist, we're all about demand and supply, and we're trying to look at this in an integrated way, understanding that whether here in the U.S. we participate or we don't, we are, you know, going to lose a lot of human capital and potential productivity if we just simply say, well, we don't want to do it, we can't do it, it's too costly, we're going to waste a lot of resources. I think that's a cop-out and is going to leave us in the dust. Now, public support, many different configurations of public support, direct government spending, bond issuance, municipalities are doing this. You know, you look around the country in the U.S. or you go to Europe and there's a lot of, you know, support to get light rail systems moving, to build out infrastructure that diversifies the portfolio of mobility. And I think any of these are great options. You may be aware Brookings is really pushing infrastructure banks. They have a paper they just recently posted. And, you know, they're going through a lot of the arguments I think that we entertained in this paper about, you know, there's a way forward if we can find the political will. And this paper does not address the political roadblocks. That wasn't the purpose of this paper, but we recognize the political economy associated with this support. Public-private partnerships, again, you know, Brookings has done a lot of work on this, government loans to private entities. Recall the so-called Department of Energy Section 136 loans. Many of you may have read about those, and just as an example, Ford Motor Company took advantage of those low-cost loans to completely renovate an assembly plant in Michigan, where we're able to execute what we call the power of choice. What is the power of choice? Well, that plant is able to produce a conventional gasoline vehicle. It's able to produce a hybrid vehicle. It's able to produce a plug-in hybrid vehicle, and it's also able to produce a battery electric vehicle all on the same line. So that flexibility allows the company to acknowledge that, you know, consumers may be picking to buy battery electric vehicles, they may be picking, you know, to buy others. So, you know, like any lending program, there are going to be winners and losers. That one in particular was a big winner because it did enable, especially in the post-financial crisis period, to garner some very needed funds in the form of a loan. So there are many success stories. Now, on green bonds, that's a concept that I have been working on for a while, which allows for, and you'll read in the paper a little more detail about this, but it allows for the potential for a company or some joint venture or presumably the government, possibly municipal or others, to issue a bond that may have a convertible feature so that there is a return to the investor holding that bond over time as this alternative technology begins to take off. So there's some asymmetric return to the investor over time. Further, you'll see in the paper a little discussion around carbon credits. And another feature of this bond could be that it allows for some obtaining of carbon credits should we have a cap and trade, you know, system where the investor would accrue credits that would have some monetary value. Now, some of those structures you'll know if you have read about the system in Europe, there have been some favorable features of that, particularly with electric utilities, but there is also the case that it's a very thin market with some, unmarket, non-market-like features that haven't materialized yet. But again, thinking ahead to the future, that's another attribute that could be embedded in a green bond that could allow for greater support for infrastructure or actual building of these alternative fuel vehicles to make them more attractive from a pricing standpoint. And then we mentioned the private feature in terms of funding, because, look at electric utilities are at the, sort of the nexus in terms of hybrid, but particularly plug-in hybrids and electric vehicles, because they're going to be supplying the stuff to make those vehicles go. And given the current structure and laws with regard to electric utilities, I think Kim was pointing this out to me. I wasn't aware that, as an electric utility, you can't resell electricity. We can't do that at Ford Motor Company at our world headquarters. That has to be sold by the utility. It can't be a product that can be sold by another entity. So there are some other legal aspects of how electric utilities are going to not only fund the infrastructure build out, but how are they going to get paid in the form of return on those bond issues or other financing instruments. So that I think is going to work out over time. I don't see that as a major inhibitor to the infrastructure build out on the electric side. The question is, what's the pricing and what's the scalability over time? Because you saw in those projections, you're still not getting to a scale, even by 2030, that gets you a point of a decent return on that physical infrastructure. So that's a little bit of the challenge. Well, let me just recap, and then I'm going to turn it over to Santiago, who's going to be our discussant on the paper. As Joshua mentioned, through 2030, we estimate about $90 billion would be needed. And again, recognizing that's a central tendency, it's not accounting for the price of infrastructure changing over time. It's a static estimate, and we hope to, perhaps enhance that as time goes by to really focus on, what that would be in dollars discounted. Now, China's central government has committed to expanding new energy vehicles in order to reduce pollution and dependence on oil imports. That's a big deal, and we shouldn't look at that lightly because we are synced up globally. It has an impact on us. If we just let them go, we'll go ahead and we're not innovating and participating in this, I think that is not, not appropriate. So I emphasize that. I probably should have put that in caps. Historically, most major markets have relied on public funding to support infrastructure. Whether your debt ratio is 90, 100, 200%, there's a payoff. If we estimate it properly, there's a rate of return on that investment that if we do our cost-benefit calc properly, that is, very important to do. And we shouldn't be thinking along the lines that, if we need to really be austere, we shouldn't do any of this stuff because there's a significant benefit over time. So with that, I'm going to ask Santiago to come up and discuss our paper, and Joshua and I will be over here, and I think after that, Paul will do some Q&A.
Yes, ma'am. That's exactly the plan.
And I think you're going to pull up a file? Okay.
Hi, good morning. My name is Santiago Pinto, and I work in the research department in the Federal Reserve Bank of Richmond. And I will be discussing Ellen and Josh's paper. Just as I'm kind of new to the Federal Reserve Bank, but I know that I have to, emphasize this disclaimer. So the views expressed here are mine and not necessarily of the Federal Reserve Bank of Richmond or the Federal Reserve System. Well, first of all, thank you for the invitation, and thank you for this opportunity to read this paper. It was very interesting. I learned a lot. Let me emphasize that I'm not an expert in the automotive industry, and for me there were a lot of acronyms. I had to get used to those, and I kind of kept a list of all these acronyms, but it's a really very interesting paper. It's a long paper, but it's kind of very well written, very well explained. And I learned really, really a lot, so I appreciate the opportunity for me to discuss this paper. So let me kind of summarize. I mean, I know it's kind of weird to give a summary of the paper. It's just for you to know the context in which I'm looking at, or I will base my discussion in a few minutes. So behind the idea of the paper is that, that for the adoption of alternative fuel vehicles, we need to develop a substantial refueling network, right? We need to develop the infrastructure. And, but obviously, and in order to do so, and in order to stimulate and encourage the availability of these alternative fuels, we need to, put a lot of money down, right? And the paper does a great job at estimating the cost associated with the development of this type of infrastructure needed to support the development of alternative fuel vehicles. And it also describes, more towards the end of the paper, the government involvement in this type of funding, and what kind of role the government should have in terms of financing this type of alternatives. So that's how it goes back to the theme of the conference, right, in terms of the public investment and the role of the government investment. So this is the kind of framework that I have in mind when I'm coming up with the comments that I will that you will see. So, okay, so the emphasis in this in the paper the chicken and egg type of problem, right? And the issue here is that drivers will not find attractive to drive or to buy alternative fuel vehicles if there's not a well-developed network where they can actually refuel well, not only just refuel, just the whole infrastructure that is needed to accompany the development of alternative fuel vehicles. But at the same time, or on the other hand, energy producers, automakers, and the government will not find it interesting to invest in FAV if there's not a big demand or a large market for those type of vehicles. So we have this kind of chicken and egg type of story. So where should we work? Where should we put our efforts, right? And what I will base my discussion on is, okay, like let's look at this whole story of the chicken and egg all together, right? And let's look both at the supply and the demand side of the story, right? So the first thing has to do with the adoption of alternative fuel vehicles, right? So this is typically the case of a good that in game theory, that would be the case where we see network externalities or adoption externalities. So typically what the utility of an individual consumer will increase as you have more users, right, of this type of good. And so then you as a user, you expect or you have some idea of how many people will actually pick those alternative fuel vehicles. And in those type of models, in game theory, you typically have what is called multiple equilibria. So you have an equilibrium where everyone coordinates, right, and everyone picks, these alternative fuel vehicles. And then there's other equilibrium or more than one where nobody chooses them, right? So that's typically happening in those type of things. That's why the issue of realizing about what's driving the demand side it might also be relevant. So the issue is that typically for this, once in this type of goods, once we get like a threshold number of consumers, we have just a self-sustained type of equilibrium where the demand will be self-sustained, right? But we need to get to that point. And what has happened, and some of the comments that I will make earlier, is that they were kind of failed attempts to try to go to those equilibria where everybody kind of adopt alternative fuel vehicles, right? There's another type of externality that has to do with, okay, we already have a network well developed for internal combustion engines, right? So all the institutions, the networks, the transportation, everything has been developing for many, many years around the internal combustion engine type of system. And so there is what is called an excess inertia, that people tend to stay with that kind of vehicles. They do not want to change to a new alternatives, right? So that's kind of all things that have been kind of well studied, and I think that they are useful in the context of the demand for alternative fuel vehicles. And so the issue of dethroning, the ICE or the internal combustion engines this is going to be difficult. And typically in the past, what has happened is that alternative fuel vehicles, they are really costly. They have low functionality. Typically, again, consistent with the story that perhaps relative prices favor ICE. Again, the transportation network, everything, the technologies, everything co-evolved around the ICE. So understanding these challenges, I think, are kind of relevant to be able to overcome these feedback effects that are actually taking place and that are kind of reinforcing the establishment of the system that we have right now in place. So it is important to understand is that any evolution of new technology will be strongly path dependent, right, as it's been in the past. So for this type of situation, this kind of situation, analysts have suggested diverse approaches to stimulate a sustained transition to an alternative fuel vehicle system. And some argue for the incentives in the form of subsidy to consumers, to automakers, to fuel providers, and in order to overcome this type of chicken egg. But again, as I was emphasizing, it's not only in the theory that you have these multiple equilibria, it's like in real life, we've seen a lot of programs that with great intentions that have failed in the past, right? And we want to make sure that now it's going to be different, right? And that once, and again, and it only takes, according to those models, efforts to get to that equilibrium out there where we will get then a self-sustained development of the system. So, but for this, it's important to understand the full dynamic implications of any intervention or any policy, that at the end what it might do is, with the idea of stimulating alternative fuel vehicles, they might end up hindering the large-scale adoption of those. So history kind of gives us a lesson about what happened, and to my understanding, again, I'm not an specialist, but what I've been reading is, obviously, that when the first type of cars, they were originally run on steam and they were electric vehicles, right? So steam was developing at that time. Electric vehicles were attractive. Again, they were quiet and they didn't smell. And there was started some kind of improvements in terms of battery performance. So the internal combustion engines, actually, they were a late entrant relative to the other type of developments. And despite being the first mover, the steam engines and the electric engines were actually overtaken pretty soon. And what was the idea there? Well, the idea is why did that happen? Well, there are lots of explanations for that. People say about changes in preferences. So people, they wanted to go and ride in the countryside. So they don't want to be stuck in the city where you have where you can actually get all these the electricity, or you can have the steams and so on. So they wanted to go other places. Then the skills of the people, mechanics and all those kind of things, they knew more about what was going on with the type of technology that was embedded in the ICE type of vehicles. And then all these were just then there was just a series of innovation spillovers that actually take place on ICE type of vehicles, and that started that kind of feedback effect that is something that is lasting up to here. So, so this kind of, again, if we go back, it's something that happened perhaps earlier on, and that was perhaps one of the first failed experiments to come up with alternative fuel vehicles that was taken over by ICs. And again, what I'm raising this is just to acknowledge this kind of issues that we were going to face, and it's not going to be easy to move towards or transition towards an towards a system where we have more alternatives. So, going back again to the adoption of these alternative fuel vehicles, so if you look at on the consumer's perspective, right, you have a wide range of alternatives, right? So you have hybrids, you have biodiesel, you have fuel cells, you have a lot of alternatives, right? And so this is a context for a consumer's perspective of imperfect information. People don't know about relative prices. Again, there are stories. I was telling about my experience I know in Brazil and Argentina about these cases where in the 90s people were encouraged to convert their cars to natural compressed gas, right? Because gas prices were really low. So people were running everywhere these cars on gas, and they have all these refueling stations and so on. And then suddenly Argentina went back from being an exporter of natural gas to an importer of natural gas, where so the price of gas really went up. The government ended up trying to subsidize consumers because they were stuck with the natural compressed gas technology in their cars, and they had invested that kind of money. Similar situation happened in Brazil with the price of ethanol, right? That again, it was subject to all these international prices, right, and fluctuations. And again, at the point Brazil went from being an exporter of sugar cane to an importer, and then to subsidize the consumption of this biodiesel and those kind of things. So there are things that, from a consumer's point of view, it's reasonable, to think, okay, how about all these alternatives? But I don't know really what's going to happen with those kind of alternatives. What's going to happen with the relative prices? What kind of risk am I getting into if I just make my decision to invest on a certain type of vehicle? So again, and the idea is, again, so if we work on this side of the market, right? So we know that, and again, what the theory tells us that as we get to a threshold number of users, then these systems will become self-sustainable. But how do we get there? That's the kind of issue, right? So there's some research that perhaps that focus again on this kind of the adoption of alternative fuel vehicles. So there's a couple, for instance, that look at, there's a paper that look at what is the consumer's valuation of an additional refuel station, right? So this is a paper that was written using data from in Germany, right, where they look at the people's marginal willingness to pay for an additional refueling station. So that's kind of give us some idea of the marginal willingness to pay, and those are kind of things that we can use in a cost-benefit analysis that to evaluate different policies that might be of interest, right? So that's kind of an interesting line of research. Then there's other papers that look at the determinants, what really determines the adoption of alternative fuel vehicles. So there's this thing about people learning about the cars, and they learn from other users, basically, right? And this is kind of the network effect, right? So the idea is that, this paper focuses on hybrids, right? And we know that there are different hybrids with different qualities, and what they were looking is, okay, if we have a penetration rate of certain kind of hybrids, whether this will stimulate the consumption of those kind of hybrids. So this is kind of, again, going back to the network type of effect. And what they find is that actually it depends on what kind of hybrids we are looking at, right? There are different qualities. So I think in this case they were looking at the Prius. Yeah, I don't know if I can say brands. But they were looking at the Prius, I think, and the Inside. And they said, for instance, they concluded that higher penetration rates of the Prius increased the demand for Prius. But higher penetration rate of the inside actually reduced the demand for inside. And that was consistent with the idea at that time that the inside was not quite a good car. But again, I don't know about that. So again, those kind of things that look at the determinants of how people adopt new technologies, essentially. There are other technologies, other papers, again, that look at, okay, why are people adopting new cars if perhaps what they do is they pay upfront more, higher price, right? But then they have all these savings later on, right? And they say that some people, due to the way they discount the future and, kind of time-consistent issues and those kind of things, they don't make the correct calculations, so they tend to get stuck with their current cars, right, with the current technology. So this is also another interesting research that looks at the determinants of adoption of alternative fuel vehicles. And when we look at what is the government role in here, so definitely the government has a role, but we have to be careful about what kind of role we assign the government. So for instance, this is an experiment that they did in California, where they wanted to stimulate or encourage the demand for ultra-low emission vehicles, right? And what they did, the way of okay, so actually these were hybrid vehicles achieving 45 miles per gallon or better. So if you had a car like that, then you were able to get a sticker that allows you to go through the HOV lanes, right? And so here we have, again, even though alternative fuel vehicles, they are good in the sense that the impact on the environment is lower, right? You still have the congestion effects going on, and you still have other effects going on, right? So you might still have more cars out there, and this is essentially what happens. So once you remove one hybrid or hybrid from the regular highway and put it in the HOV lane, then that spot is immediately filled up with another car, and actually you end up having more congestion. So actually you have that objective that you wanted to encourage the demand for these FABs, but at the same time you are creating another externality, right? So again, just to be smart about what kind of policies we want the government to get engaged with. I work a lot in urban economics, so in urban economics we have this kind of chicken and egg type of story, especially when you look at the revitalization of downtown areas, right? That typically, that people move into the suburbs, right? The downtown area end up empty, so now the local governments, they want to incentivize people to go back, right? And again, it's kind of the chicken and egg type of story, because once you have a critical mass of people willing to go back to the downtown area, then things are self-sustained. You don't need to do much. But how you coordinate people to be willing to go there, right? And and there are good experiments here and bad experiments in this area. So there are places that the government invested a lot of money, and the downtown area is still empty. And there are experiments where they actually just had a very minor participation, and that immediately encouraged people to go into the city and things, develop by themselves. So again, it's just I put this as an analogy, going back to the type of demand that we are facing when we look at these new technologies. So in summary, what I'm perhaps wanting to look at is, okay, first of all, we need to identify here the externalities that are involved in this type of goods, which is a very specific good. What is it the kind of, again, usually we tend to think that this might be unnecessary but not a sufficient reason for government intervention. But again, it's just important, again, due to the externalities that I was talking about, there are a lot of different type of externalities. What kind of policies do we want to get engaged to, on the supply side, the demand side? What is the rationale for government intervention? And this, as usual, has to be based on a cost-benefit analysis, and that's why, all this other work that I was telling you might make sense. And there's another point that has to do, who is in charge of doing that? What kind of, and it might make a difference, right? So you may have local governments perhaps developing some kind of rail system or public transportation based on certain type of fuels, right? That will be great. But in terms of refueling stations and so on and so forth, the development in a decentralized way might be some kind of chaotic in a way. So that might be also some role for the federal government to get engaged in that. Even though in the last few years, there's been more like a trend towards the defederalization of the transportation system. So beyond these kind of things, this is also a situation where you have multi-jurisdictional spillovers, And those are kind of things that have to be addressed in a way or another. So with this, I just want to conclude. I want to thank you for the opportunity of reading the paper. I learned a lot. And again, just my comments are basically based on the kind of challenges that we are facing on this kind of thing, which again, and my suggestion is to look at this in a kind of an integral way, okay? But thank you very much for the opportunity.
Thank you. Is this?
Yeah, I'd like to say thank you to Paul, and I'd like to acknowledge and say thank you to my co-presenters today, Robert Hockett and Steve Clemens. Truly grateful. As you folks know, there is a raging debate between stimulus and austerity on public debt. Those who are in favor of stimulus point to the right-hand side of this chart and say that although government debt to GDP is approaching 100%, it's lower today than it was in 1945, and post-war growth solved that issue. However, this debate tends to omit the discussion of private debt. And when we add in private debt, we see a different story. Private debt from 1945 to the present has almost tripled in size. Private debt in 1950 was about 50% to GDP. Now it's 160% to GDP. And it's important to focus on private debt because it was a rapid increase in private debt, not public debt, that caused the Great Recession. Let's look. Here you have residential mortgages to GDP from 1960 to the present. And you can see that from 1960 to 2000, those numbers grew about 16% per decade. But starting in 2001, we had what I would consider runaway lending. In fact, in the 6 years from 01 to 07, mortgage debt to GDP grew 46%, and in the 10 years ending in 07, grew 68%. And if you compare those numbers in 07 to a trend line that continued that 16% growth rate, you see that we created $2.5 trillion in excess mortgages. And higher asset values are not a mitigant because the true constraint to debt is income. In fact, in 06 and 07, the very years we should have been the most worried, consumer assets were calculated to have grown more than consumer debt, and a lot of economists were going around saying the consumer was in better shape than they had been historically. In fact, a few said that to me. It was the inevitable spate of non-payment by overextended borrowers after a period of binge lending that brought the Great Recession, and of course the resulting retrenchment of lenders in that environment. So I don't want to insult anyone's intelligence in this room, but why does high debt to GDP matter? Well, it's obvious that if a home or business owner has a high level of debt, they have reduced capacity for additional spending or investment. In aggregate, a country's capacity for growth is constrained if its citizens and businesses collectively are operating at high leverage. Now, it further makes sense that private debt is the core issue here because it's the biggest number. If you look at the end of 2011, non-financial private debt, and all of our comments today are about non-financial private debt, was $25 trillion. That dwarfs the size of GDP at $15 trillion. It dwarfs the amount of public debt at below $15 trillion at that point. It dwarfs the money supply, the oft-discussed M2. It dwarfs trade. Exports were about 10% of GDP, or $1.5 trillion. It dwarfs tax receipts, which were less than $3 trillion. A 10% change in any of these other numbers, a 10% change in tax rates, a 10% change in tariffs, anything like that is dwarfed by a 10% change in lending. And in fact, in the 10 years ending in 2011, private loans grew by $9 trillion, flooding the U.S. economy with additional demand. Another reason to consider private debt to be the central issue is that it correlates much more closely to GDP growth. Here we've gone through the very simple exercise of looking at year-over-year increase in private debt and compared it to year-over-year increase in GDP and year-over-year increase in public debt. And on the left-hand side, you see that from 1970 to 2011, and you can see the red line, year-over-year growth in private debt, correlates very closely to the year-over-year growth in GDP. The dotted green line, public debt, is much less correlated. You see that on the right-hand side in the period from 1990 to 2011 in Japan. Again, private debt and GDP are very closely correlated. Public debt, not much at all. And I've done this, so I'm going to suggest to you, go to any country, pick any slice of time, and you'll see something pretty similar to this, which leads us to argue that GDP is driven by changes in private lending. This private debt number correlates more closely to GDP than either consumer debt or business debt separately. It correlates more than M2. It correlates more than things like trade imbalances and the like, which are often cited as drivers of GDP outcomes. So it got us to thinking, if runaway private lending caused the Great Recession, did it also lead to the Great Depression? And sure enough, when we look at the nominal data in the decade leading up to 1929, we see a 66% nominal growth in private loans. If we translate that into private debt to GDP, we see the blue line on the right, or about a 40% growth in private loans to GDP during that decade. Now, what if we take the same line from 1997 to 2007? Well, it lays more or less right on top of that blue line. You see the same 40% growth in private debt to GDP in a single 10-year period. It was runaway lending in both periods. So it's reasonable to then ask, if the 1920s and 2000s each had 40% plus growth in private debt, how many other times in the last century has private debt growth been 40% or so in a single decade? Well, let's get our bearings for a moment. Here is a bar chart of private debt to GDP, the blue lines, from 1916 to 2011. The red line is public debt to GDP during that same period, a much smaller number, obviously. So let's just look at private debt to GDP, and we can see there are 3 times in the last century where private debt to GDP grew 40% or more. The 20s, the 2000s, and then the period right after World War II, the late 40s through the early 50s, when private debt to GDP was at a century-long low. And it kind of makes sense that there would be a releveraging that needed to occur. Now notice something else about this graph. There are only 2 periods in the last century where private debt to GDP is meaningfully above 150%. The 20s and the 2000s. To us, that's predictive. If your private debt to GDP is above 150% meaningfully, and private debt grows more than 40% in a decade, you got yourself a crisis.
Since my role is to interrupt, can you explain what the 2012, 2013 levels is? Is it still in decline or still?
It is now going back up. We are re-leveraging, and it's...
You knew the answer to that question.
Steve, I love you. So, the good news is we now have a tool for predicting and, frankly, preventing the next major crisis of this magnitude. But how do we miss something this obvious? Well, one very important reason is that a lot of prevailing economic theories and forecasting models ignore debt as kind of net zero, as not part of the real economy. I had one person who reviewed our paper say, well, you know, I found it very interesting, but I do most of my work in the real economy. So, we also have the false comfort of low interest rates. You can sustain these overwhelming burdens of debt when rates are near zero. And further, it's widely held that loan growth is always bullish. You know, pick up any article you want in the last few years from the New York Times, Wall Street Journal, and elsewhere, and if they're talking about loan growth, it's an optimistic article. But we are, as Steve's question illuminated, we are still well above the 150% private debt to GDP level. And growth's harder if you're lugging around a heavy burden of debt. So how would you advise decreasing our high ratio of debt? Should we pay it down? Well, we had a little experiment in paying down private debt. It's called the Great Depression. In fact, let's look. And these are nominal values here. You see the red line, which is that build-up in private debt to GDP that we already talked about. The blue line is GDP moving along with that. And the green line shows that public debt's kind of a non-factor in the period leading up to the Great Depression. And then you have something remarkable happen. You have a decline in nominal private loans outstanding of almost 25% in about a 3.5-year period. That's unthinkable in today's world. To give you a little preview, after the Great Recession, private loans declined nominally 3%. And not surprisingly, GDP declines at a similar slope of line and a similar dollar amount, but since it's a lower base, it's about a 44% nominal decline in GDP. Again, essentially unthinkable in today's world. Then you had a few famous things happen in 33, and things started limping back from that point forward. Now, why did you have an almost 25% contraction in loans in a 3.5-year period? Well, you had runs on banks, and if you're a banker, which I was the CEO of a bank for decades, and you lose your deposits, you got to call loans. So there's a technical reason this was happening. But it was also the attitude of the times. It was viewed as the remedy. Treasury Secretary Mellon famously said, liquidate labor, liquidate stocks, liquidate farmers, purge the rottenness out. Enterprising people will pick up from less competent people. It was viewed as the remedy. Instead, it created an enormous, unprecedented contraction. So the single biggest lesson of the Great Depression for economists was to avoid major debt pay down, a liquidity crunch. Thus, in the 2000s, we again had runaway lending, but no massive pay down after the crisis point. So instead of private debt contraction of 25% and unemployment of 25%, it was 3% and 9% respectively. Here we see the 10-year period leading up to the crisis. It's almost identical to the pre-29 period. You have this 40% run-up in private loans. You see GDP responding nicely. Everybody thinks they're rich. You can see the green line is much less of a factor, public debt. But as the crisis begins to occur, you have a nominal decline in private loans of only 3%, as we just mentioned, and not surprisingly, a nominal decline in GDP of about 3%. And things are on their way back up. We're re-leveraging, which, you know, at one level is a good thing. One of our fundamental arguments in this presentation is private lending leads GDP growth. And if you did this on a private debt to GDP basis, we had a decline of 10% from the crisis point, but we're still 15% above the year 2000 and 53% above the year 1980. So we avoided depression, but we have what we would call a new dilemma. Deleveraging contracts the GDP, and re-leveraging promotes growth, but it increases the structural precariousness of the economy and dampens future growth. The Eurozone crisis, if we had time, is identical. Spain is off the charts, 220% private debt to GDP. The Japanese crisis of 1991 was identical. You had a 40% run-up in private debt to GDP ending in 91. The Asian crisis of 97, in South Korea, in the 10 years prior to 97, private debt to GDP increased 63%. You had a crisis. What you see if you get into this is the whole world is on this steady path towards being more and more leveraged. No matter what part of the world you look at, and almost irrespective of what country you look at, you have the same phenomenon. So how would you advise decreasing our high levels of debt? Paydown causes economic contraction. Getting government debt under control is a good thing, presumably, but it does create short-term GDP pressure. It's in the formula and does not address private debt levels. Growth or inflation work, but it takes a generation or two because the numbers are so big. Get your spreadsheet out. I'm willing to sit down with you. You can't make this happen in any reasonable time frame through GDP growth or through inflation. That leaves our favorite, debt restructuring. And when we say our favorite, it's the least lousy out of a bunch of lousy choices. So our favorite lousy choice is debt restructuring, which, if you bring it up, immediately brings a chorus of protests on moral hazard and objections regarding wealth transfer. But if you think about the fundamental problem, private debt to GDP being too high, it's the correct mathematical solution. And $1 trillion in loan forgiveness or restructuring creates the same impetus to the economy as $1 trillion in new stimulus without adversely affecting our country's debt ratio. Or we could live with it, which is kind of what we always do. And with that, let me turn it over to my colleague, Robert Hockett, to talk about some potential solutions.
Good setup for you, Bob.
That was very compelling.
If you can't do something with that, then we're going to fire you.
All righty. I'll do my best here. So I think Richard made the case, I think, as well as it can possibly be made, right? A very compelling case to the effect that really it's all about the private debt, stupid, not the public debt. Both when we're talking about sort of what fuels a bubble, and then also when we're talking about what protracts the sort of post-bust depression that often occurs after a bubble has indeed bust. Maybe one quick reference that might be worth making just for your to add to your reading lists before moving on. Paul has talked a little bit about or mentioned one of our joint heroes, J.M. Keynes. He's also talked about another of our joint heroes, Hyman Minsky. But one other person who tends to get sort of short shrift, who I think everybody ought to go back and read, is the great American economist Irving Fisher, right? The first great American mathematical economist, who unfortunately doesn't get his due because he's best known for having said, I think it was mid-September of 1929, that stocks seemed to have reached a new permanent plateau. But he put his money where his mouth was at that time, and he lost his fortune as well. So he spent a good bit of time trying to diagnose what had gone wrong, right, what had happened in the aftermath. And he wrote an absolutely terrific little monograph called The Debt Deflation Theory of Great Depressions in 1933. And you'll find a terrific sort of theoretical framework through which to understand all of the empirics that Richard has so exhaustively cataloged for you, and that I hope that both of us have adequately at least summarized in the first parts of the paper. Now, the reason I want to emphasize that briefly before we move forward is because if you pay close attention to the dynamic that Fisher explains, both in terms of the lead up to, or the sort of the dynamic pursuant to which a bubble inflates, and then in terms of the dynamic pursuant to which a post-bust depression can end up being protracted, one of the key takeaways is that this is not so much a matter of individual blame or stupidity or moral turpitude on the part of any particular market participant. It's really essentially a collective action problem that we're dealing with here, which is to say we're dealing with a situation in which multiple individually rational decisions aggregate into a collectively irrational and calamitous outcome, right? Essentially it's a kind of prisoner's dilemma problem, a kind of tragedy of the commons problem, a kind of arms race problem, right? And that bears directly upon the wisdom, I guess I'll say, of the proposals that we're about to make, because our argument is that a lot of the standard moral hazard arguments that are often leveled against debt forgiveness are simply inapplicable here. They're not apposite, okay? So if you would, keep that in mind as we move forward. And then, of course, when we do Q&A and discussion, we can sort of get into further detail if need be, okay? So the first point to make then, as far as debt restructuring goes and what our remedies, what our recommended remedies are, is first that these are simply offered in the nature of, or as sort of discussion points, things that, possibilities that we ought to think about. We recognize that some of them are going to be a little bit controversial, that most of them, if not all of them, probably require further study to determine whether they're good ideas or not. But we think that they definitely should not be ruled out of court ex ante, that these are worth a serious hearing, okay? Second point is, if you look at the composition of the debt overhang in the shadow of which we're living right now, you'll note right away that the overwhelmingly larger part or greater part of it, not surprisingly, is underwater mortgage debt. So we attend primarily to that component of the debt overhang, but we also look a little bit at what has recently become the number 2 component. It's just in the last 3 years has edged out credit card debt, and that's student debt. So we'll say a little bit about student debt forgiveness programs as well. But the main focus will be on mortgage debt, okay? All right, third sort of preliminary point to make before moving forward to the specific proposals is to note that you can partition the class of underwater mortgage loans into 3 salient subclasses, right? So one subclass comprises the so-called portfolio loans. These are whole loans held primarily by banks, but also by some other financial institutions like insurance companies. Basically, various financial institutions or intermediaries that hold some whole mortgage loans in their portfolios, basically among their assets, right? That's the first subclass. Second subclass of underwater mortgage loans are those that are held in various forms by the GSEs, Fannie, Freddie, Ginnie, some of the others. All of which, well, the principal GSEs of which are regulated by and currently held by a federal regulatory agency known as the Federal Housing Finance Agency, or FHFA. So you've got the GSE, we'll just call them for shorthand, I'll just call those the GSE loans. That's the second subclass. And then finally, the third subclass are those loans that are held primarily by so-called securitization trusts, private label securitization trusts to be more specific. I'll call those the PLS loans, okay? Now, here's the thing to note. There's a somewhat different tale to be told about each of these 3 subclasses of underwater mortgage loans. And the differences between these 3 tales that can be told are instructive, we think, when it comes to determining what to do about the problem that we now face going forward, okay? So to begin with the portfolio loans, if you look at those loans that are held as whole loans by individual institutions that don't have particular difficulties making decisions, like banks, you'll note that the rate at which those loans are being written down is high and still growing. That's to say, portfolio loan holders are already voluntarily writing down portfolio loans in large numbers and at growing rates. Why is that? It's not very difficult to understand, right? Basically, we know that underwater loans are subject to very high default risk. In fact, the default rates are just enormous as negative equity grows. And when you get to 160, 170 LTV loans, the rates at which those things default are just astonishing, astronomical. Now that means that the loan itself, the full face value of the loan, is going to be lost. It also means that all the transaction costs and legal costs that are occasioned by foreclosure proceedings on the homes that secure those loans are going to be triggered. And the institutions that hold those loans consequently realize that by writing down the principal on some of these loans, the most underwater ones, they actually raise the expected values, the EVs of those loans. That's to say, it's sort of win-win for debtor and creditor alike to write down principal on some of those loans. Obviously not all of them, but a significant subclass or subset of the full set of those loans can actually see their values raised by writing down principal. And so the portfolio loan holders do that, again, at high and growing rates, nevertheless not at rates as high as they might be if one of our proposals is adopted, namely a regulatory forbearance proposal that we'll come to in a minute, okay? Next thing, consider the GSE loans, okay? Well, yeah, the GSE loans. Let's, actually, I'm going to jump over GSEs for the moment and go straight to PLS. Because here you can see a very dramatic difference in the tale to be told about the PLS loans on the one hand and the portfolio loans on the other. So PLS loans are written down hardly at all. And insofar as they can be written down, and by can I mean something very specific and legal that I'll come to in a moment, insofar as they can be written down, they have been. All of them that legally can be or could have been written down pretty much have been written down. And that's about 5% of them since the crash, since 06, 07 really. Tiny little percent of those. Why is that? Why do you not find write-down rates among PLS loans that compare to the write-down rates among portfolio loans? Is it because the trusts that hold the securitization trusts that hold those loans are more stupid than the banks, that they're not as good at calculating what's in their best financial interest than the banks? Is it that the loans themselves are so different that you can't actually raise values by writing them down? I don't think that's the case at all. In fact, what we have is an unbelievable array, an astonishing array of specific market failures and market rigidities that prevent the securitization trusts from doing with those loans what the portfolio loan holders are able to do. I'm just going to focus on a couple of them. There's, if you want to see a full, sort of parade of horribles, there are 14 or 15 of them that are all separately cataloged in a few of the papers that we cite to in our paper. But a couple to focus on is, first of all, the so-called pooling and servicing agreements, or PSAs, pursuant to which the securitized mortgage loans were securitized in the first place, typically place limits on how many loans can actually be written down, how many loans within the trust. Typically, they're very small percentage limits. They also typically prohibit the sale of underperforming loans or problematic loans out of the trusts by the trustee or by the servicer, right? So that's one thing. Secondly, when they don't outright prohibit that sort of thing, they make it very difficult by imposing supermajority voting requirements of various kinds, pursuant to which basically all of the bondholders or large numbers of the bondholders in these trusts all have to agree, meaning that you end up getting the sort of classic creditor collective action problem on steroids in a case like this, because these people can't even find each other much of the time, let alone all come to agreement on what the terms of a restructuring of a loan should be, okay? And there are various other problems in the PSAs, and then there are additional problems as well that sort of obstruct anybody who would like to write down PLS loans. What that means is essentially what we're faced with here is contracts, PSAs, that have come to function effectively as suicide pacts among bondholders. And you might wonder, how could that have happened? How might that have come to pass? Well, these PSAs appear to have been, by and large, formulated during a time when all these people out there in the world, if a few people other than Paul and other than Richard, were saying, well, real estate prices can only go up, right? You can't have a nationwide or worldwide real estate collapse, and therefore we don't have to provide against that possibility, against that contingency. Hence, we can write these PSAs that place these excessive restrictions on trustees or servicers when it comes to doing value salvaging or value raising write-downs in the event of some massive market collapse of the kind that was thought to be impossible when those PSAs were formulated. That means, in turn, that any solution that we're going to come up with for the PLS loans is going to have to be effectively contract busting. It's going to have to be, the PSA is going to have to be treated kind of like a contract between two parties who come to an agreement at some stage, at say time T1, on the basis of some misapprehension or mistake, right? Some misunderstanding as to what the risks are out there. Later, a risk that they didn't foresee eventuates. Both parties realize, oh, this contract is no longer good for either of us. Let's rescind it and rewrite it in light of new circumstances. Effectively, we have to replicate that sort of situation for the PSAs. But you can't get all the bondholders to come together to do that. You have to bust through these suicide pact contracts in another way. There are basically two legal ways to do that. One is bankruptcy, which, for reasons I'll explain in a second, regrettably does not apply here, can't be used here. The other is the use of government's eminent domain authority, which just is a contract rescission authority or a contract-taking authority. So the solutions that we're going to advocate in the case of PLS loans are of that nature, okay? And then finally, third, going back for a moment to the GSE loans, you might say, well, what's the story there? Because those aren't being written down either. And does that mean that we've got the same contract rigidities or problems? Or does it mean we have, an agent, kind of like a financial institution or a bank, that just isn't as smart as the banks are in writing down their portfolio loans? Well, the answer is it's really neither of those. The problem seems to be largely the way in which benefits and costs of write-downs are calculated by FHFA in determining whether indeed writing down certain loans would enhance the value of the portfolio that FHFA effectively owns right now. The problem here, just to try to avoid being too technical about it, is when FHFA calculates what the expected value rise is going to be by writing down the loans, they offset those benefits by reference to particular costs. And among the costs that they include in that calculation are HAMP fees, for example, that they seem to think they would be paying servicers under HAMP in order to do what is actually in the best interest of, the holder, the owner, the GSEs in the first place, and so they discount by that. And they look at other sorts of costs, sort of tax-related and other costs, basically to the public fisc as a whole, to the national finances. Whereas it's probably better for FHFA, as conservator of specific entities, the GSEs, to look at what the relative costs and benefits to the GSEs themselves are, and not to assume that they have to pay HAMP fees to bribe servicers to do what's in the best interest of the portfolios in any event. So the solutions that we're going to offer then address all of, basically we have solutions that we hope address the GSE problem and that we hope address the PLS problem, and then finally also that might boost the rates at which the portfolio lenders are writing down principal on the portfolio loans, okay? All right, so hoping that I've got this right. Sorry, this is just a bunch of stuff. This is a bunch of data that's in our paper that sort of shows the magnitude of the problem, of the underwater mortgage loan problem, and the sort of local concentration of it. In any event, so to begin then with the sort of the most controversial, just in case I run out of time, how to deal with the PLS loans. So remember, I noted that the problem is we've got these suicide pact PSAs. Sorry, Paul.
PSL stands for private label securitization, so that everyone knows.
Oh, right, yeah. So PLS, private label securitization trust, typically it's a trust that holds the loans and then issues bonds, against those loans. And then the contract pursuant to which these loans have been securitized is called a pooling and servicing agreement, or PSA, okay? Now, The problem in the case of these PLS loans, right, these private label securitization loans, as noted before, is the PSAs themselves, these dysfunctional contracts that now function as market rigidities. Essentially, they're acting as market failures because they're preventing the market right now from doing what it would otherwise do best, which is to revalue the loans themselves, because the loans are worth less than they appear on their faces, right? So how do you bust through those? Well, remember, I noted that there are only two ways you do that, two ways to bust through a contract in the case when a contract becomes a suicide pact. And you've got a lot of contracting parties, so they can't come together and solve this problem themselves. One is bankruptcy. So one is bankruptcy, as noted before. The problem, and this is what we do all the time, right? Bankruptcy does this. The whole point of bankruptcy is to salvage value when it turns out that you've essentially got a turnip, right? You've got a turnip, you can't squeeze blood from the turnip. In other words, you can't make the turnip pay everything that it owes. You try then to sort of work things out in such a way that as much value as possible can be salvaged. That's what bankruptcy is all about. That's what it's for. That's how it functions when it's functioning best. The problem in the case of mortgage loans is the so-called primary residence exclusion from Chapter 13, which is just a legalese way of saying that you can't get bankruptcy protection for the home in which you reside. It's just the code is not applicable here. So one possible solution that I've advocated for the last couple of years that some people will think, oh, this is like the worst of lawyerliness, right? This is sort of too clever by half. Say, well, if you've got these judges who are all sort of into the plain meaning of statutory words, just get out of your primary residence. Stop living in your primary residence, but keep owning it, and then you might enjoy the benefit of Chapter 13 bankruptcy workouts. So the idea that I've put forward the last couple of years is, there's this significant architecture that's developed over the last 5 or 6 years in the wake of the housing bust, just because housing markets are so problematic, whereby one person who's living in one part of the country and wants to move to another finds somebody else in another part of the country who wants to come to live where he or she has been living, and they simply trade houses. And there's a significant web architecture out there already to facilitate so-called house swapping. So the thought occurred to me, why not do something like this even locally, and I'll call it lease swapping. So essentially, Richard lives in one house, I live in another house. These are our primary residences. We're both underwater. Richard and I have sort of similar tastes, similar aesthetics. I like the way he decorates, I like his house. I move into his, he moves into mine. He keeps owning his, I keep owning mine. We basically enter into a lease arrangement, right? I lease my home to him, he leases his to mine. Now our primary residences are no longer our owned residences, and voila, you might well get stripped down or crammed down of the kind that the Congress has failed to enact, even though it's been tried in 2009 and 2010 to bring homes under the bankruptcy code. They can't seem to get that in Congress because you can't seem to get anything out of Congress these days, for the time being at least, so just operate that way. That would be one possibility, one way to get through the PSA limitations that prevent value maximizing or value salvaging write-downs, or as they would be called under the bankruptcy code, strip-downs. Okay? Another possibility is to use the eminent domain authority, as I mentioned before. Now things get a little bit more complicated in this case, but the basic idea here is you get a government. I advocated this in 2007 or 8 originally, and there I was advocating that it would be a federal government instrumentality. Subsequently, I sort of moved over to state or local government instrumentalities for a number of reasons that we can get into if we have time, but we probably won't. In any event, what you do is you get a government to partner up with private investors. Ideally, they would be the current bondholders themselves. MBS is mortgage-backed security. Ideally, you get the current bondholders themselves, right, who are basically seeing money left on the table right now, right, because they themselves can't write down those loans, right, that have to be written down in order to salvage value. If those bondholders could put up the money that has to be paid in the condemnation proceeding, that's to say the eminent domain proceeding, if they put up the money to pay the fair value for the loans, then the loans can be taken out of the PLS trusts and replaced. They can be rewritten, restructured, replaced with new loans that have essentially no negative equity, maybe a 95 LTV from a current 170 LTV, something along those lines. And the beauty of operating in this way would be that the bondholders, in effect, would be doing in two steps what they would ordinarily have done in one step, right? What the portfolio loan holder, the bank, does in one step, the bondholders would do in two steps, precisely because you need the extra step because the contract, the PSA, prevents them doing it directly now. So they partner up with municipalities, basically to target deeply underwater mortgage loans whose values can be raised by writing down principal on them. And in effect, they're paying themselves, right? The fair value that's paid for the loan, they're paying to themselves. They're, of course, paying themselves less than the face value of the loan, but that's just another way of saying that they're writing down the loan, right? That they're giving up some face value amount in return for salvaged value, for raised expected value. And I maintain, and I think we can empirically show, that there's a significant number of PLS loans out there that have that basic attribute, that the attribute that their expected values can be raised by writing them down. So that's the second sort of major proposal for the PLS loans. Okay. Now, what about the less sexy or exotic ones? I mentioned something about regulatory forbearance. And I mentioned that in connection with the possibility that you might actually get more write-downs on the part of the portfolio loan holders themselves, and maybe more write-downs from, or some write-downs at long last from the GSEs themselves. Well, one possible inhibitor that's preventing portfolio loan holders from writing down as much as they otherwise would is, of course, the universal fear that if you actually start writing down loans, you're actually officially recognizing or telling the world, whoops, these loans aren't worth as much as we thought. In other words, that our assets are not as highly valued as they appear to be on the books, right? That's always the sort of the universal fear, right? That I've heard people overstate this. It's got to be overstated, but sometimes people who like to say things for effect, certain bondholder advocates I know say, oh, the banks, they're all zombie banks, right? If you actually look at the real value of these home loans that they have on their books, they're worthless, right? And that means that these banks are, functionally speaking, zombie banks, and then the OCC and other regulators are trying to kind of help them pretend not to be because they think there's going to be another panic and so forth. I think that overstates the case. But the case that it overstates is nevertheless a real case, which is to say, a lot of the portfolio loan holders are probably holding off from some write-downs for fear that they're going to look to be in a less robust financial condition than would be gleaned from the books as the books currently appear, right? Furthermore, some of them worry, well, their CAMELS ratings are going to go down, right? In other words, the regulators are going to see them as being more troubled than they would otherwise be, and that's going to trigger higher capital requirements, right? Because as a lot of you probably know, the capital requirements that you're faced with ride on your CAMELS rating, and the A in CAMELS is a reference to assets, including loans, right? So another thing that Richard and I then propose that's a little bit less radical and a little bit less out of the box, but nevertheless we think quite sensible, is to say, all right, why don't we allow banks that have significantly underwater loans whose values could be raised by writing them down, essentially to segregate off those loans themselves. It's sort of a variation on Sheila Bair's good bank, bad bank idea, right? Segregate off those particular assets and give them a special regulatory treatment. Say, okay, look, these assets are going to be treated as being worth more than they are probably in real terms for some defined interval, maybe a 10-year interval, and then you have a kind of a gradual straight line method amortization of those particular assets over time, while the bank is working to restructure those particular loans in negotiations with the debtors. That would be another way of operating, another sort of helpful move, okay? All right, a couple last points then, moving to student debt, and then I guess I'll stop because I'm probably getting pretty close to running over already. When it comes to student debt, again, the problem here is about 1/10 the magnitude, if not a bit less than 1/10 the magnitude of the underwater mortgage loan problem. But it's still a significant problem and a growing one. As mentioned a couple minutes ago, several years ago, it became the second largest, and it's becoming worse, right? This basically a kind of concavity to the sort of the rate at which that problem is growing. Furthermore, this is a particularly sensitive group of loans, because if you think of it in terms of demographics, who are going to be the fresh, lovely, exciting cited new families starting, young entrants to the economy, and to the home buying market, the demand side of the home market. Typically, it's going to be graduates, people who have recently graduated from school and who are now saddled with immense levels of student debt. That suggests that this group is worth looking at as well. And there are a couple of proposals out there that have been made by others that we think are very much worth considering. Right? So the first is to, when it comes, you can once again partition student loans into two classes or two sources, right? There's private lending for student debt, and then of course there's federal lending for student debt. Private student debt used to enjoy bankruptcy code protection, but in the bankruptcy code alterations that were made in 2005, that private debt was taken out of the bankruptcy code, meaning that student debt, private student debt at least, now is on all fours with home mortgage debt as far as the bankruptcy code is concerned, which is to say it's not there. It doesn't enjoy any protection. So Senator Durbin has suggested, all right, why don't we revisit that? Why don't we go back to the 2005 amendments to the bankruptcy code and say, whoops, probably made a mistake on the private student debt piece of this, and put that back in there, okay? Second proposal is the Student Loan Forgiveness Act of 2012, proposed in Congress just about a year ago now, a year ago this past month. Hanson Clark, I believe, from Michigan was the congressman who submitted this. The basic idea here is essentially to sort of enhance certain contingent loan forgiveness programs that are already out there, right? So you get a medical degree, you serve in a particularly underserved area, you get partial loan forgiveness. Used to be that you had to do that. In order to enjoy that forgiveness, you had to serve in this underserved area for at least 10 years. So Representative Clark says, well, cut it to 5 years, all right? Do the same thing with respect to other kinds of service that people might engage in, that they might use their degrees in. Then again, you get contingent loan forgiveness. And then another sort of centerpiece of the plan is the so-called 10-10 plan. And the idea there is to say, all right, anybody who qualifies for this program, if you pay 10% of your monthly income or yearly income on paying down your student debt, and you maintain that for 10 years, 10% of your income goes to student debt payments for 10 years, the rest will be forgiven, okay? That's the sort of second attribute of that plan. We think that that's worth looking at as well. And we don't think that those particular plans are afflicted by the same kinds of moral hazard problems that other kinds of plans might be. But if you want a more systematic and comprehensive coverage of all of the different proposals that we think are worth looking at, I guess I'll just encourage you to look to the paper, and I hope I at least gave a kind of a reasonable summation of what the core of the paper. Thanks.
Thank you, Bob.
I'm gonna
You run over, so, okay, thank you, good job, 15 minutes.
Yeah, I'm just gonna make that. Not a genuine discussing. To explain my being here and participating today, I work with Richard Vague. I'm Steve Clemens. I'm editor-at-large at the Atlantic Monthly Magazine, but work with Richard, who many of you may not know is sort of the king of the affinity credit card business in the United States. That, you know, your airline miles donated to the University of Richmond, that whole business Richard helped create. So it's rather unusual to be discussing strategies about debt forgiveness with someone who's been on the opposite side in the finance, personal finance area for someone, but Richard very much knows debt. And, I find the paper fascinating, and Robert and Richard have presented the bulk of it. I just thought I would share some thoughts. I'm a political guy. I'm not, write a lot about economic stuff, but the political dimensions to this really fascinate me. I have a couple of modest differences with Robert at the end, but I think the big question is, are we in a time or not where, given the scale and size and, frankly, the complicity of certain actors in the Great Recession of 2007, 2009, which we're still suffering from, in which there was government action on behalf of some of the players in that. It was very interesting. Within a year, you had 5,000 people that bailed out firms that had $1 million bonuses or higher, and you saw those that were left with mortgages under loan or unemployed or other after effects of a major financial crisis. And so it's been interesting to look at the kind of moral hazard questions applied to people that were essentially, you know, maybe they took out too much credit, et cetera, et cetera, et cetera. But it was a system that's, you know, a formula that systemically you had very other complicit players, both in the financial sector and the regulators, that created what I consider to be kind of an era of structural corruption. And in that you had, of course, winners and losers, but rather than rewiring the social contract and the way in which these component pieces of the economy worked, we essentially resuscitated the system, but we left this burden of debt with a great number of working Americans, and that debt still exists out there, and that's an interesting problem. It's also a problem that's not really at the banks, it's at other institutions, as you said. And the question is, you know, if you read, I'm not an expert in this, but David Graeber's book on debt, I commend it to all of you. If you ever want to know any dimension about debt, this book deals with it, and it looks at, you know, ancient times and looks at the phenomena of jubilee, that every once in a while you basically had to squeeze the system. I found it very interesting. One of the people that Richard Vague is most loath to quote in anything is Paul Krugman. But nonetheless, if you read Krugman's piece this week called The Urge to Purge, I'd like to just read it for a moment. He says, let me just get it here. Yes, total debt in the US economy, public and private combined, has risen dramatically relative to GDP. This doesn't mean that we as a nation have been living far beyond our means, according to Krugman, and must drastically tighten our belts. While we've run up significant foreign debt, the rise in debt overwhelmingly represents Americans borrowing from other Americans, which doesn't make the nation as a whole any poorer and doesn't require that we collectively spend less. In fact, the biggest problem created by all this debt is that it's keeping the economy depressed by causing us collectively to spend too little, with debtors forced to cut back while creditors see no reason to spend more. And that really is the crux of it. And so it gets to the question of, does this period of time and the incident that we saw justify an action in this era to deal with one of the largest crises or not? And if you were able to kind of create, I hate the notion of debt forgiveness, but some notion, and my biggest difference with you on the student loan issue is you put the right and responsibility of loan with the loan recipient, as opposed to creating dynamics in the system that allow those loan holders to write off and work out that debt. Anyone that's familiar with the commercial loan arena, particularly in commercial real estate, know that there are workouts done all the time. And when I lived in California, we had the real estate crises in California as well as Arizona, and I was running something called the Japan America Society of Southern California, and all of our Japanese banks were essentially hiring regulators from Washington to figure out how to do workouts and manage, you know, this arena. What's happened, what we see regularly in the commercial area, is not happening in the individual or the consumer loan area. And the question is, why not? And can you change the incentives? And from my viewpoint, it's an interesting question of asking if you're able to look at regulators that would allow, because of the fear of insolvency and because of the capital ratios and, you know, insolvent institutions, if you were able to create a zone where this would be the legislative and the political item, where you allow those banks and financial houses and others that hold those debt to have a longer runway for writing off that debt. That's all you, in my book, that's all you needed to do. Move it from 10 years to 20 years to 30 years. And so it's, you don't make it a mandate, you don't impose it, but you give them the option. My sense is many of those institutions will run that direction because it will, they're already recognizing that internally anyway at the real values. And the question is, if you can basically create that structure that allows them to run it off, then it's not the same thing as creating an industry for debt forgiveness, which, with all due respect, I think you're sort of talking about. With the loan thing, you're basically creating a one-time fix structurally in a deal between regulators and mortgage holders and other loan holders to extend the period of write-off so that those loans reflect real values. And my sense is it doesn't fix it and clear it up for everybody. It would clear up a lot of it for, you know, and it would remove, in my sense, you would get real reduction over time, and, you know, real economists would have to look at that in the kind of overall level of private sector debt to GDP. Now, the only other comment I would make, which is often kind of neglected in these issues, I live in DC and I, you know, participate a lot, you know, in the debt debates. We had Eric Cantor having a party in the Westin Hotel here in town last night. You know, it makes you think about all this stuff. Is that governments, all the governments that Richard has been looking at over a period of time, you know, when you look at the massive rise in government debt to GDP, they are responding to private sector events. One of the real realities of what we talk about is the private sector messes up. You get too much credit extension. You get bubbles. And the other thing we haven't been talking about, we've been going from bubble to bubble to bubble. About every 3 to 4 years, somewhere in the world, there's a massive bursting of a bubble. And I would argue that we are, I don't know where it will happen, but we're probably ripe for another such incident right now. And so governments, whether the US government or I saw this during the 97-98 East Asian economic crisis and the kind of hubris the U.S. economy had at the moment. People like Alan Greenspan and others saw this as good, as a kind of deflationary impact on the increasing prices of wages. That we've got kind of bubble-led growth and bubble-led factors, an awful lot. And that's what we're trying to sort of say. We need to move out of that. In the U.S., in the commercial real estate areas, or maybe student loans, or others may be looking at other potential bubble bursts that could be problematic. But you get a private sector event, and then the government has to make the decision of, does it seek, move into bailout? Does it use its various fiscal and monetary instruments to keep things afloat? And then you see these massive rises in debt. But and that's when it becomes political, because all of a sudden your stakeholders are taxpayers. And it's all the taxpayers are bitching about, why am I bailing out my neighbor who was fiscally irresponsible or financially irresponsible? And I think that this is what is interesting about the period of time we're in now, because to some degree, what Richard and I, and now Bob and Richard, are arguing is that the government debt debate that we're having today is a distraction from the real factors of what's going on in the private sector. And while we're debating the level of what is the appropriate level of, whether it's, what Paul Krugman spends most of his time arguing about, we're arguing is the wrong debate, that you fundamentally have a systemic problem in the other side of the equation that's getting very, very little attention. And we may have the wrong prescription for it, but nonetheless it continues to exist. And so when you look at the data that we're looking at from economy after economy after economy at the level of the private sector debt you have to ask over time, whether you're Ford Motor or you whatever, where do you get growth? Where's the spring in the step that you finally move to at that level when you're in what we're basically saying is there's a flashing red zone that we continue to be in? There are a lot of studies out there. I've got friends at McKinsey that have written this study about deleveraging and what the stories of deleveraging are around the world. And when they wrote the report 2 years ago, they argued that we were well on the way to a kind of serious deleveraging in the U.S. Either you look at the aggregate, it's not true anymore. You see the increase in leveraging right now, and you still have this bulk of debt that continues. And that is where we're trying to sort of move the focus of policy attention. Now, how do you do that? And begin to walk into those questions of moral hazard and the risk issues. I don't want to create a business for writing off loans like I think you're implying, in the student loan case. But I do think that there's a window for public policy responsibility that you could move into this without necessarily generating something that creates an ongoing pattern of vested interests that essentially want to engage in credit acquisition and then default, which I think would be the wrong lesson to set. So I'll just stop there. I think it's a very interesting paper. I'm not a genuine discussant because I'm complicit in what you guys are trying to do. But I do think that that the U.S. economy continues to be in a fragile state. We see recovery, et cetera, but it's not recovering until you have the next bubble. And if you have this massive untouched burden on the back of working Americans and they can't work out of it, if you don't create something, it doesn't have to be the Andrew Mellon approach of purging the entire system, what Krugman called the Mellonites, but you've got to find ways back there. And the biggest thing, and I'm not sure Richard mentioned it, is when you do think of this, depending on where you are in the stimulus versus austerity debate, which I'm finding increasingly vapid, if you do believe in the stimulus approach, the one burden in that argument that I don't see enough people answering is that with our approach, if you're able to find some politically palatable way to readjust and do workouts for working households, the economic impact of that is far greater than the economic impact of adding to the debt burden of the government and trying to push money in the economy. And so it's a mathematical reality that you'll get far more economic activity and stimulus through a non-traditional stimulus means, which is writing off or reworking that debt in some way. And that, I think, so you get activity without adding to the overall aggregate debt burden of the federal government. So I'll stop it.
We're good. I have the dubious distinction of being right after lunch. I gave that to myself as the leader of this thing, since somebody's got to do the after lunch. I have one graph up from the paper that Zoltan and I just did, which is our second paper under the mantle of the Society of Fellows. The first was at the Central Bank of France a year ago, and the title of that paper was, "Does Central Bank Independence Frustrate the Optimal Monetary Policy Mix in a Liquidity Trap?" Which I was actually quite proud of the paper, as well as the title, because it put squarely on the table that we were in a liquidity trap and we needed to rethink monetary and fiscal policy coordination. This most recent paper, which came out early this year, it's got an even more provocative title related to helicopter money. And I like the paper, but I'm not going to walk through all the graphics in the paper today. Actually, I just want to talk to you, if that's okay. And hopefully the topics that are in the paper will come through. But I have a very serious scholarly axe to grind that A, we're in a liquidity trap, which I will define for you, and that in a liquidity trap, that which used to be considered to be unorthodox now becomes orthodox. And that what we used to think was unthinkable now is the base case scenario. So those are my overall priors. But actually, I want to start with some fundamental sort of thoughts on the issue of the relationship between monetary and fiscal policy in advanced economies. For the most of my career until 5 years ago, the doctrine of central bank independence was sacred. You could not advance in the economics profession if you ever questioned that proposition, that monetary policy was sacred. It was not to be discussed in political circles, that you could not trust politicians to deal with monetary policy issues, or you would have an incipient runaway inflationary problem, that we needed to cordon off monetary policy to professionals and then let our democratically elected officials deal with fiscal policy, because we kind of had to show some lip service to democracy. That's what I spent 30 years of my career being shoved down my throat, that the private sector could solve all things, that public investment was actually an oxymoron, that everything the private sector did, by definition, if you believed in the efficient market hypothesis, was good, proper, and fitting, and societal optimization. Obviously, I've become a cynic in my old age, and I think democracies have become cynical as well around the world. So I'm giving you my priors right up front, and then I want to get down to some brass tacks issues of what's going on in Japan, Europe, and the United States. But first, I want to walk through a really simple exercise. So everybody got a bill? It can be of any size. So I want to walk you through an exercise here. Has anybody ever studied this thing, of what is actually on this thing? You've done it, Bob? Okay, you're a wonk just like me then. You've actually studied what's on this thing. I'll tell you what's on it. I have to take my glasses off to read. I'm one of those weird people. At the very, very top of this thing, it says Federal Reserve Note, N-O-T-E. What is the concept of a piece of paper that has note on it mean to you in day-to-day life? What's a note? It's a debt instrument. Evidence of a loan, a debt instrument. We got two check mark answers here. It is evidence of a loan and a debt instrument. And it says Federal Reserve Note. So therefore, this is a liability of the Federal Reserve. It says that right up there at the top. The next line says, the United States of America. Okay. So Federal Reserve is on top of that, so therefore we can safely assume, I think, that the Federal Reserve is a subsidiary of the United States of America. Everyone with me here so far? We've all done notes before on houses and cars and to brother-in-laws. This is not a brother-in-law loan, or maybe it is, I'm not sure. But it says at the top, Federal Reserve note. Now, down here on the left-hand side says something really cool. This note, note it said note, a debt instrument, a loan obligation. This note is legal tender for all debts, public and private. This note is legal tender. What does legal tender mean?
Money you could pay with it.
Legal tender, meaning that if I owe you money, let's call it $100, and I give you 100 of these, what have I done? I have legally fulfilled my obligation to you, right?
You discharged your debt.
I have discharged my debt. And it says, you can't sue me. If I owe you 100 and I give you 100 of these, you cannot sue me for non-performance because I paid you in legal tender. Why is this called legal tender? Because the Congress of the United States of America declared it to be legal tender. Okay. This is kind of a cool thing, right? It's a note of the Federal Reserve, and it is legal tender. Now, some of you have been CEOs or chairman of companies. If your company borrows money by issuing a note, Richard, I'm sure you've issued a few notes in your time. If your company issues a note and you're CEO of the company, who signs the note? You sign it as the CEO, right? You normally expect that the CEO of an outfit will put his signature as CEO, obligating the company to repay the note, right? That's how it normally sort of works. This is a Federal Reserve note, so therefore I'm looking really hard to find the chairman of the Federal Reserve on this note.
Who do you find? Like the Treasury Secretary.
I find the Treasury Secretary of the United States of America, and in this instance, Mr. Tim GIC, who a number of us know. So it's a Federal Reserve note declared by Congress to be legal tender for all debts, public and private, but it's not signed by the chairman of the issuing entity called the Federal Reserve, but signed by the Secretary of Treasury, who is appointed by the President of the United States and confirmed by Congress. There's a lot of interesting history and civic lessons written in on this note. A couple more features, three more features on this note. Now, we said that a number of us have engaged in either receiving a note or issuing a note, either borrowing or lending money. What's one of the things that frequently is associated with a note? Do most notes that you've ever been engaged with have an interest rate associated with them? When you took a mortgage, did it have an interest rate associated with it?
Indeed.
It did. The borrower wanted higher, or you wanted it lower, right? It's kind of how it works.
That's how it works.
It had an interest rate on it. Did it have a maturity date on it?
Yes.
it had a maturity date on it. So a conventional note that you're used to has a interest rate and a maturity date on it. You pay the interest and pay the principal, and in the case of a mortgage, 30 years later, you have what, where I grew up about 100 miles from here, it's called a note burning party. You ever been to a note burning party? Am I the only one old enough in this room to remember when people actually paid off their mortgages? We actually, where I grew up, about 100 miles west of here, would have actually note burning parties with people in the church and the community. When finally they had paid off the mortgage on the house, would invite family, friends, people from church over, and put the note and a punch bowl and light a match to it. That was considered a cause for celebration. You ever heard of such a thing? You may have been to a note burning party, just not in recent years. All right. So most notes that we're familiar with have a interest rate on them and also a maturity date. I cannot find an interest rate on this thing. Have you ever found one, Bob?
I've not. I think it's a perpetual, isn't it?
Well, that's dealing with the maturity date. I can't find an interest rate on it, and I can't find a maturity date on it. A very interesting note. Because you told me earlier, I think it came out of your mouth, that it is a debt instrument, right?
It's a debt instrument with no interest.
It's a debt instrument that has no interest and no maturity date. Therefore, it's a zero perpetual.
It's a zero perpetual. Yep.
A zero perpetual. Have you ever issued any zero perpetuals, Richard? I think there's probably a reason. I don't think the market would take your zero perpetuals. I don't think the demand would be particularly robust. Doesn't mean that I haven't had, at various moments in my life, an impulse to try. I think it'd be really cool to have a printing press in the cellar of my house. I live on an island in Newport Beach. It'd be really interesting to have a cellar in my house. But let's assume I had a cellar in my house. It'd be interesting to have a printing press where I could go down and print up some zero perpetuals. What would that be called?
Counterfeiting.
Counterfeit. You're really good. Maybe you should go into the law.
I thought of it.
You thought of that, huh? Okay, it would be illegal for me to do that. That's true. What I would really like to do is print up some and have this thing called legal tender associated with it. I print it up and you gotta take it. An extinguishment of everything from my mortgage to a Big Mac with fries at McDonald's. That's what legal tender is about. The reason I go through this in excruciating detail, and I recognize it is excruciating, is to try to let you know that this is something incredibly special. And it says at the very top, Federal Reserve note. But actually, the Federal Reserve is not like anybody else. It says Federal Reserve note, but also says the Federal Reserve is a subsidiary of the United States of America. The Congress of the United States of America, duly licensed to do so by the Constitution of the United States of America, the right to coin money and the value thereof, has declared this to be legal tender. It's signed not by the Federal Reserve Chairman, but by the Treasury Secretary. It has no interest rate on it and no maturity date. One other last thing it says on the very back. You want to guess the last thing it says on the back?
In God we trust.
done this before. You've never seen me do it before. In God, we trust. This is something really, really special. It actually is hugely important in our society. Now, as a practical matter, we as a people, and not just here in the United States, and not just currently, but globally, through time immemorial, literally time immemorial, have been very hesitant about giving elected officials the right to go down to the cellar and print these things up. Why have we been hesitant to give elected officials the right to do this at whim? Quite logical reason is most elected officials are elected because they specializing and promising to give more than they take. I know very few elected officials who have done the opposite. The last I recall vividly promising to do such a thing, if elected, was in 1984 when a certain fellow named Walter Mondale said, if elected, I will raise your taxes. What happened to Mr. Mondale? He didn't have a robust result. Inherently, the political process would tend to overproduce these things because it is legal tender, and they reserve for themselves the monopoly right to print it. So therefore, it's understandable that people, time immemorial, have been reluctant to trust their elected officials and representatives to handle this stuff. In fact, you go back into history, what did kings used to do with this stuff? Well, actually, back in those days, I was just in Italy not too long ago and got to see the scene in modern day banking with the Medicis. What did they tend to do with the gold coins?
Sort of filed off the edges and taking a bit more for themselves.
They would file off the edges and also put a little bit of lead in them. Elected officials would tend to debauch, devalue, and abuse these things, otherwise known as inflation, right? Inflation. So therefore, while this is a very valuable thing, the right to print these sorts of things, we have to give, notwithstanding all of my comments earlier today about Congress where Steve works, we have to give Congress and our elected officials credit for saying we don't trust ourselves with this. This would be crack cocaine in our hands. Take it away from us. Do not let us have it. Do not trust us with it. Ergo, we have the doctrine of central bank independence. There's nothing inherent about the economics of monetary and fiscal policy that requires central bank independence at all. It's a practical reality that this is simply too powerful, particularly in America with a 2-year election cycle, to be trusted to Congress and to Congress's credit. To Congress's credit. But if you note, I said something to the credit of Congress. Delegated that responsibility to the Federal Reserve, which is de facto the 4th branch of government in America. I say de facto because it was created by Congress. Congress is one of the 3, and it was given by the Constitution the right to fool around with this stuff. So they said, don't trust me on this, I will create an independent agency to do it for me, called the Federal Reserve. Other countries have done the same. In fact, the United States moved to central bank independence a long time before a lot of other countries did. In fact, Japan only moved to central bank independence about 15 years ago. And in Euroland, the German Bundesbank used to be independent, but most of the other central banks of Europe were not. And in the UK, it was only 15 years ago that the Bank of England gained its independence from the Treasury. So central bank independence was not written by this fellow noted on this bill called God. It was simply created in various capitals around the world. In fact, when you look at emerging markets historically, you had no central bank independence. So it is not as if ordained by God that you have central bank independence. It is a convenience at particular epochs in time. And I'm using the phrase epic for a reason. Because you can have long periods of time when central bank independence serves a purpose. But it's not through eternity as if ordained by the divinity. Now, the heyday of central bank independence, coming down to the real world here and get off the fun part. This is fun. The heyday of central bank independence in the United States began in 1979. In fact, it was August of 1979 when Jimmy Carter appointed Paul Volcker to be chairman of the Federal Reserve. I am old enough to remember the day that happened. Does anybody remember who Paul Volcker's predecessor was? Very back. G. William Miller, who will go down in history as one of the less memorable, efficient, productive Fed chairman in the history of our country. He was nominally independent, because the Fed has been independent in the United States ever since 1951, after it ended war finance at that juncture. But Mr. Miller was a buddy of Mr. Carter. And during the second half of the 1970s, our country did have a nasty inflation problem. It wasn't necessarily a consequence of bad Fed policy. Stuff happens. We doubled oil prices twice in the 1970s. So stuff does happen. But Mr. Miller was not willing to take tough action against inflation, otherwise known as throw people out of work. We hear, Paul Volcker was the giant of inflation fighting, which is true, but you fight inflation by throwing people out of work. And it takes a fair amount of political courage to throw people out of work. Just as a sidebar about G. William Miller, historically he was actually the CEO of Textron, so he wasn't a finance man at all. He was been pretty heavily involved with the president during the campaign. He became president in '76, and he thought the Federal Reserve was like running a corporation. And reflecting a positive thing about Mr. Miller, he was way before his time in having an aversion to smoking. This was back in the 70s where we didn't have all the laws that we have right now. And back then, Paul Volcker, who was the president of the New York Fed, smoked cigars like a pot-bellied stove. It was also exceedingly cheap cigars. You paid $5 for $1.39. They smelled like burning car seats. And Mr. Miller came in as chairman of the Fed, so he puts out on the big boardroom. Have you ever been in the Federal Reserve in Washington? It's a beautiful boardroom. So he puts out on the boardroom little signs that he had his assistant make up, no smoking. First thing that happens is he starts his first Board of Governors meeting, first FOMC meeting actually. Paul Volcker comes in and fires up one of his cigars. Told you he just wasn't attuned to exactly what was going on, but the irony of the whole story is that Jimmy Carter actually moved G. William Miller over to the Treasury, and actually he did the Chrysler bailout at that juncture, and Paul Volcker came in. And essentially Paul Volcker said, I don't care about anything except inflation, and I will drive interest rates to 20% and throw millions of Americans out of work, and I will break the back of inflation. That simple. And the interesting thing is when Reagan came in, Reagan said, we will stimulate the economy by having big tax cuts. Mr. Volcker said, that's fine, you can have all the tax cuts you want, but you're not going to stimulate the economy. Because monetary policy is going to dominate fiscal policy, and whatever you do just means interest rates are going to go higher because we're going to throw a lot of people out of work and break the back of inflation. So fiscal policy totally was dominated by monetary policy. That was actually at the beginning of my professional career, where monetary policy was at the top of the heap and fiscal policy was a footnote. Total dominance by the monetary authority, which otherwise known as this box on the chart down in the bottom left-hand corner. And the next 30 years was tended to be called the Great Moderation. It was a great time for our economy with one large caveat. And the paper you just heard before lunch demonstrates the very large caveat, is we deregulated credit creation to the private sector. We deregulated the financial system, broadly speaking. Well, we got rid of Glass-Steagall and all this sort of stuff along the way. But essentially, the private sector was deregulated from access to credit cracking, and therefore became quite addictive, as Hyman Minsky predicted would indeed be the case. So we had a 30-year great run in our economy, except for the fact that it was also on the back of serial bubbles, the last one being a very large one in the first 5 to 7 years of this millennium. And it all went bust. It all went bust. And in 2007 and 8, a fundamental rethink of the relationship between monetary and fiscal policy took place. And it's still taking place. And it's a function of the fact that we entered something called a liquidity trap. And I promise you I will define that, and I will now define it. A liquidity trap is when you have an overhang of debt in the private sector such that the overwhelming objective of the private sector becomes de-levering their balance sheet even at low interest rates, including 0. And the best analogy I have come up with for the Federal Reserve in a liquidity trap, the Fed's been at 0 since December of 2008. That's fairly long stretch, is in a liquidity trap. The Federal Reserve becomes the bartender at the Betty Ford Center for balance sheet rehabilitation. They're delevering. Those with money don't want to spend it. Those with debt halfway to the moon don't have the right to borrow more. So therefore, you have a bifurcated economy. You have rich people and rich corporations afloat in liquidity. You have over-indebted borrowers who can't borrow for love nor money because they have excess debt, manifest most clearly, obviously, in negative equity on their home. Ben Bernanke is a friend of mine, and my heart goes out to him. It must be terrible to be a bartender at an AA meeting. You cut the price to zero, and you still can't sell any bigger. That's essentially what a liquidity trap is, and it has huge implications. As Richard and Bob laid out in their paper, you look at it historically, I don't know what the number is precisely, but there is a tipping point in our economy of private sector in debt where it implodes, sometimes referred to as the Minsky moment. And on the backside of a Minsky moment, monetary policy becomes impotent. Because private sector agents are delevering. They're no longer elastic or sensitive to interest rates. I don't drink. It's not a matter of price no more. I don't drink. I don't borrow money. That's simple. That is a liquidity trap. When you're floating in a sea of liquidity at no cost, but the private sector is under forced pressure to either delever or build precautionary balances. But in any event, you reach an equilibrium in your economy that is depression-like. That monetary policy can't get any easier, but you still have 8% unemployment. And the private sector is trying to de-lever. Now, as a theoretical matter, it probably still is the right answer in the blue books of college and graduate school. We're supposed to know enough as a profession never to have liquidity traps again. That we did that in the Great Depression, and therefore we will learn from those mistakes and it would never happen again. That's still taught, right? I guess it wasn't until 2008, with the Japan exception, but they're kind of weird anyway, so therefore we don't have to worry about that. That it will never happen in the United States of America, for God's sake. Well, it did. It obviously happened and continued for a long, long period of time, called 20 years in Japan. It also happened in Euroland. It was the south of Euroland that had its Minsky moment. And it was private sector debt. I would love how you brought that up in your paper. That Spain didn't have a public sector debt problem. It had a private sector debt problem. And it all came a crackle. So that's where we are in Japan for the last 20 years, 25 years. It's where we are in the United States. And it's where we are in Euroland, called 3 for 3. We were not supposed to have liquidity traps because the efficient market was not supposed to create bubbles. Well, the efficient market hypothesis seemed to be less than pristine and prescient. We did end up with bubbles, which is simply a product of human nature more than anything else. And they blew up in 3 different places. And ever since, we've been redefining the issue of central bank independence. I'll do the other 2 countries, come back to the United States, and I'll actually be on time, which no one predicted I was going to do. And Japan. I actually traveled to Japan shortly before it all blew up in 1990, which is 23 years ago. It was very early in my career. And that's when the palace of royalty was worth more than the entire state of California. You start going over there about that time, or was it a little later? I'm sure you went over there. It was the ultimate bubble. It was a private sector debt bubble, and it blew up. And we've spent the last 2+ decades of deflation and debt overhang. The corporate sector is amazingly flush in Japan. It's the household sector that's not. It's the household sector that is your overhang issue in Japan, and a lot of it's related to the fact they still haven't, quote unquote, gotten even 20 years later on their property. Now, Japan also has demographic issues, but we can leave those aside for a second. They had their Minsky moment a long time before I created the term Minsky moment, which I did in '98 for Asia. I guess it was Asia back during that period, but not in 1990. So Japan has been in this mess for a long, long time. The private sector wants to borrow. You have a similar situation in Euroland. The private sector wants to delever, not to borrow, to delever. And we have that in the case in the United States. Now, everything we know about macroeconomics is the way I learned it and taught it and practiced it and retired at 50 on, is that evidence should be observed. Evidence should be observed. And that if you're in a liquidity trap, you're in a variant of what is known as the paradox of thrift. I'll explain that one to you. The paradox of thrift is simply that which is rational for the individual is irrational for the community of individuals. The paradox of thrift deals directly with the issue of savings. It can be rational for any individual household or person to save more. In fact, I have a 24-year-old son, and sometimes I will give him an evangelical sermon about the importance of saving. Some of you parents may have given a similar evangelical message. There's nothing wrong with the sermon. Saving can be individually rational, moral and just and all that sort of stuff. But the fact remains, at the macro level, at the aggregate level, one person's spending is another person's income. And income is the fountain from which savings flow. It's okay for me to have an impulse to save. But if we all get the same impulse at the same time, we have a very huge macro problem. If I decide to say, please don't you decide to do the same thing, because your spending is my income. And if you save more and I save more, I cut your income and you cut my income, and we get into a down the plug hole of the liquidity trap. The paradox of thrift is a variant of the fallacy of composition for those who are academically persuaded. If I give you a very simple example, and this one always works, brings it home to people. You ever been to a ball game or a good concert, and you get this impulse, I will stand up and I'll get a better view. Totally rational. Everybody in your section has the same impulse at the same time. What's the outcome? You're all rational, right? I'll stand up, I will get a better view. Turns out all of you stand up at the same time. Nobody's got a better view, and you all got sore feet. What you need, you got a coordination problem. You got a collective problem. You need to have somebody, would everyone please just sit down. A collective agent. Would everyone please sit down? Everyone's going to end up with sore feet, or you can sit back down. So in that instance, you acted rationally. There was nothing morally wrong with you standing up to get a better view. It's just you had the paradox of aggregation or the paradox of threat. Rather than standing up at an Eagles concert, I went to the Eagles concert recently. They're really, really good, by the way. Catch them when they're on the reunion tour. And you think it's rational and want to stand up. You need a governmental agency. Would everyone please just sit down? Now, coming back away from the Eagles concert to the real world, in a liquidity trap of private sector deleveraging, you really don't want the government going the same direction. If you have the paradox of thrift in the private sector, you actually need a borrower of last resort. If the government says, I think we will join you in standing up, we will go on a forced march called austerity. You get into the theater of the absurd. You actually need to have the fiscal authority go precisely the opposite direction. Which is why this whole concept of austerity versus stimulus debate we were talking about earlier, it drives Steve nuts, it drives me totally around the bend. Why are we having this debate? If the private sector is imposing or having imposed upon them austerity because of the post-moment bubble of debt. Problem with the debt, it doesn't deflate. The asset deflates, but the associated debt doesn't deflate. Your whole paper is about how can we get symmetry between the two sides of the balance sheet. It doesn't deflate. So actually, a logical person would say we need somebody else to do the exact opposite. But somebody else logically should be the government. Note I said the government. Well, we can't borrow money. Interest rates will go up. I've been hearing that for 5 years. My mom keeps praying that that forecast mate or somebody besides me will come right. That when I visit my mom, her usual response is, you know that Ben guy, right? I said, yeah, I've known Ben for a long, long time. Get him on the phone. Tell him I can't live on these CD rates. Mom, I can get Ben on the phone, but I don't think that, I'm going to get your CD rates going up. But then the funny part of the discussion, I say, Mom, you and Dad have saved and been frugal your entire life. You have a small little portfolio of CDs. You roll them over every 6 months. They have a laddered portfolio, which is not an unreasonable thing for elderly people to do. I think it's about 3 years, so every 6 months they have something coming due. I said, tell me what interest rate you want on your CD portfolio. And I will just personally write you a CD for whatever that interest rate you want. And we'll all be hunky-dory. And she said, nope, that would be welfare, Paul. We can't take welfare from you. But you're willing for me to call Ben and jack interest rates for everybody in the country, that's okay. We can't take, it just tells you about that spatial generation, WW2. And it's not a lot of money. They anticipated that their CD portfolio would give them $15,000 a year in retirement. That's all. Not a large sum of money, but it's not big enough to yield them $15,000 a year at 0 interest rates. It has to be a very large portfolio of CDs. So I said, I'll just write them a check for $15,000. And we'll structure it as interest rate on the CD so it's not welfare. It's all right through it. That's welfare stuff. We will not take welfare from it. So, what can you do? What can you do? But as a logical matter, what we can conclude is the guy who can issue these things should not impose austerity on himself. I can't issue them. If all of those debtors that Richard and Bob and Steve were talking about could go down into the cellar and issue some of these, your paper is null and void. I can solve the problem real quickly. I'll go down and print $300,000 of these. I'll take it down the bank and pay off my mortgage on my $150,000 house. I will own it free and clear. Problem solved, right? Problem solved. You can't go down in your cellar and issue $300,000 of these to yourself to go pay off your mortgage. If you're Uncle Sam, however, and you have the right to declare this thing to be, what did I say? Legal tender. There is no logical constraint on the ability to actually have fiscal expansion, including public investment. And there's every logical reason to have such a thing in a liquidity trap. Call me a Keynesian and you'd be correct. Now, are there dangers in subordinating the Federal Reserve to fiscal policy? Yeah. Remember I said there was a logical reason that Congress said don't trust me with this sort of stuff because it'll lead to an inflation problem? That doesn't hold in all times, in all situations. And a liquidity trap is when categorically it doesn't hold. And Ben has been pleading with Congress not to go over the fiscal cliff. He actually got that one. Is don't make me virtuous today with fiscal policy. And actually, there's tremendous scope. And it's starting to be realized, I think, a bit. My mom may complain about interest rates, but if you're a citizen and you actually need to do some infrastructure, what better time to borrow money than right now to invest it, particularly for infrastructure that employ people that otherwise we still have to take care of in our society. Quick sidebar on that notion. I hear, I'm sure you do as well from time to time, from people who are pretty deep into being capitalist about the whole thing. And the whole notion, we just need to tighten our belt up. We need to tighten. I do it in my company all the time. I wrote 50 pink slips last week. I'm proud of myself. I think Mr. Romney said something to that effect. The private sector, if I'm a private sector, I've fired people before. You fire them, they go away. And if they don't go away, you get a lawyer, give them a little bit of money, and then they go away. It usually involves giving a little bit of money, and then they go away, because your profession has to feed his family too. But as a practical matter, you can fire somebody in the private sector. We don't fire citizens. We don't fire citizens. We still got to give them 3 squares a day. So as a practical matter, if society's got to pay 3 squares a day for a guy, let's have him fix a bridge somewhere to actually work for it. So I will conclude with a very simple observation. Is on this chart we need the upper right-hand corner. I started my career in San Diego. I ended my career in Maine. I'd like to get back to the heartland. I'd like to get back to the heartland, but you can't get back to the heartland from this starting point, particularly if you're going to have forced march austerity at the fiscal policy level. That holds for the United States. It holds doubly for Euroland. Mr. Draghi and the ECB have had to effectively play fiscal authority, essentially lend the money of the North to the South through the back door, because the North doesn't want to vote to give it to the South. But if you don't give it to the South, they can't pay their money back. You cannot get blood out of a turnip. Portugal and Spain are turnips, not just Greece. And Spain is not a public sector problem. It's a private sector problem related to the property bubble. So actually, I think enlightenment is coming to Euroland through the form of Mr. Draghi, though I worry deeply about forecasting enlightenment coming to Europe. This doesn't seem to be a robust forecast, but it tends to come in in Churchillian fashion when he talked about the United States, when Churchill said, you can always count on the United States to do the right thing when they've exhausted all other possibilities. You can count on the ECB to do the right thing when the Northern Fiscal Authorities have exhausted all other possibilities, which is the notion that we will repeal the paradox of thrift. Just repeal it by fiat. And it comes back and bites them in the bum repeatedly and repeatedly and repeatedly. So I think enlightenment is coming to Europe. And actually, I tend to be positively disposed towards the equity markets in Europe for that reason, just to give you a sidebar on that. With respect to Japan, the big enchilada has happened. We're getting bona fide Abenomics and helicopter money in Japan. The Central Bank of Japan, the Bank of Japan, has lost its independence. Not legally, but as a practical matter. And the newly elected Prime Minister has got a newly appointed governor of the Central Bank of Japan, and has told the new governor, thou shalt print yen until the last dog dies. I will call you when the dog dies. That's simple. So we've totally ended the notion of central bank independence in Japan, which is absolutely delightful. It's a simple reason the stock market in Japan has gone absolutely bonkers in the last 6 months. It's good stuff. The capitalists who bemoan the loss of central bank independence are making money hand over fist. Don't expect hedge fund managers to be logically consistent in the morality. So Japan's got it. Draghi is doing it. In his famous words last fall, we will do whatever it takes. Remember that one? Whatever it takes. We will print these until the last dog dies. And we don't care. The United States is somewhere in between. The consequences of all of this money printing, if we get out of the liquidity trap. Remember, Japan's been in it for 20-odd years. So getting out of it would be a high-quality problem. If all of this subordination of monetary policy to fiscal policy and blatant fiscal borrowing to invest and employ people works, and we exit the liquidity trap, monetary policy will probably be too easy. We probably will have inflation move up a little bit. I have one simple editorial comment to say about that externality. Please, please throw me in the briar patch. All of the data that Richard was presenting is about nominal GDP. Inflation would make nominal GDP higher. Actually, inflation, as a consequence of getting out of the liquidity trap, would not be a problem, but part of the solution. Therefore, the title of my paper, written with Sultan, he couldn't be here today, he's a brilliant young man. The title of the paper is How I Stopped Worrying and Came to Love Monetary and Fiscal Policy Cooperation. And I came up with that title before the Japan equity market took off, so therefore I wasn't talking my own book. But at the bottom line is nothing succeeds like excess in money printing, getting out of a liquidity trap. And I'm actually reasonably optimistic that Washington and other capitals are getting it. Most optimistic on Japan, and even on our country. The notion that forced march towards austerity is the only path to morality is being questioned. We had an election on this issue, and I think the outcome was pretty definitive. But in any event, that's where we're coming from. I talked a bit about the paper and various sort of spots on the paper. It's very, very wonky. Sultan did a fantastic job. He was the master of the shadow banking maps. So we tried to move monetary fiscal policy into another set of maps. The paper's really cool from the standpoint of satisfying wonks. For the non-wonks amongst us, The easiest lesson I can tell you is when someone's questioning you about what's going on right now, make them read what's on the bill. It's an incredible pedagogical device to understand how our economy works. Thank you very much. And you guys are up now. Or do you want 3 minutes? 3 minutes. They want 3 minutes. Does somebody want to ask me a question that does involve anything that's illegal or immoral? Go ahead.
Yeah, read your paper. It was good. I apologize to it. In one section, you talked about how if the Fed were to commit not to ever sell what's on their balance sheet, and basically sort of create a permanent projection reserve,
Yeah.
it'd be the same thing as forgiving the debt. Can you talk about that a little bit?
That would be. In fact, Lord Turner, the retiring chairman of the FSA of the UK, just had a major paper on this whole issue. And genuine helicopter money is QE without an exit strategy. And the Fed has been doing QE and they talk exit strategy, is that we're going to do this. We're going to, essentially what the Fed's doing is printing these to buy bonds. They're actually creating bank reserves, but bank reserves can be shifted into these. They are creating money to buy bonds, but when we get out of the liquidity trap, we will de-print the money and sell the bonds back into the private marketplace. So that's a future overhang of public debt that theoretically means that people are not willing to throw risk to the side and get on with life, because there's this, yeah, this is temporary. It's like when you give your kid, you know, an extra 20 and say, but you've got to give it back to me next week. It's kind of hard for him to have a good time because he knows he's going to have to work extra next week to give the 20 back. As opposed to you say, son, it's $20, you never have to pay me back. That is permanent money creation for him. Has a very different effect. I was a college student once. I understand the difference between somebody lending me $20 and giving me $20. So actually, in that portion of the paper, when we're talking about permanent QE is helicopter money. I'm never going to decreate the money. So essentially, I'm going to finance. If I have helicopter money, QE with no exit strategy, it is financing a fiscal deficit with a perpetual zero.
Ex-ante debt forgiveness.
It's ex-ante debt forgiveness.
Do you think we should do that?
Yeah, I do. Yeah, I do. It is a free, that's the closest thing that you can get to a free lunch, and you're only supposed to go into this cafeteria to get the liquidity trap. If you go into helicopter money at any time that you're not in a liquidity trap, then you are openly inviting a nearby inflationary sort of problem. It only applies, and this hopefully comes through in the paper pretty loudly, is you hope to never be in this box where the private sector is de-levering and you need to have massive fiscal stimulus. So you need to have helicopter money so that you don't end up going up through Nova Scotia, that direction. You want to pull back towards this direction. And this would be the opposite extreme. This would be 1980. That is called a Sergeant Wallace whirl for the wonks in the room. You like to get back into this area where the private sector is actually prudently doing that which we all did. You borrow money to buy your first house, you get your first car, but then your income goes up and then therefore your finances improve. All that sort of stuff we all did. That's heartland sort of stuff. So you want the private sector doing prudent things, and you want the fiscal sector doing prudent things called investing in public goods and taking care of old people and poor people. So you'd like to get back into the middle part. So it's dangerous. And as Lord Turner said in his speech, it was a really powerful speech. You can see it on the FSA's website. He uses a lot of the work that Zoltan and I did here. You don't want to talk about money printing at all times as a permanent solution to anything. But as a practical matter, there are moments when you have to break the glass. And this is a break the glass moment on central bank independence. If we had a war, no one would argue about making the central bank subservient to the war effort. In fact, that's precisely what happened in WW2. And also through the Korean War, because Mr. Truman didn't want to finance the Korean War at market interest rates. So if we look at an 8% unemployment rate, which is actually 15 when you think in terms of underemployed in our economy, and look at the bleak future of our kids coming out of colleges and university these days, and consider this to be an extraordinary circumstance, and you also look at the negative equity problem and all that sort of stuff, it's a constellation of spatial circumstances that warrant a spatial solution, which is called helicopter money. But I would be the first to say, if it worked, not to continue it, but only when I had evidence of its working. That's one of the big issues that we have with QE now. Everywhere, is central banks say, I'm going to do it until I see evidence it's going to work, and then I'm going to stop doing it. No. This is the instance where the May-West doctrine applies. If a little is good, more is better, then way too much is just about right. Go ahead, Bob, you get the last one before I turn over to our host.
So just one really quick question. I wanted to bounce an idea off you. So as you know, one of the criticisms of helicopter money is it's a blunt instrument, right? That it tends to sort of disproportionately sort of inflate commodity prices and thus disproportionately hurt the poor.
Gives you bad inflation.
Right. So a couple of years ago, I thought, well, there's a way around that, right? The Fed could short commodities, or the Fed could short the things that the poor have to buy and pay for in order to sort of fine-tune QE a bit. But that's a fairly radical proposal as well, and so I'm wondering if you have any thoughts on the prospect of something like that.
I mean, there is the risk that you inadvertently inflate commodity prices when you debauch your currency, since commodities are a form of currency. There's no question about that. I wouldn't have the Fed shorting commodities. If you're actually concerned about that whole deal, you simply dramatically increase margin requirements on commodity market speculation.
That's
That simple.
Yeah.
It's a macro-prudential sort of issue.
Sure.
Is almost all commodity speculation is done in the forward market with nothing down, or very little down. So if you want to deal with that whole, particularly in the world of commodity funds, then essentially you just buy fiat, increase margin requirements on commodity market speculation, and it does work. Alan Greenspan used to fight all the time about the issue whether or not margin requirements would work. And the fact of the matter is, he and I agreed. He thought they would work too well, which is why he never wanted to try it. But they work amazingly well. Because you've got levered speculators and they're playing with 5% down, all of a sudden you say it has to be 10% down, they have to cut the positions in half. It works exceedingly well. Thank you for your wonderful attention. This has been good fun. And bring us home, man, okay?
Thank you very much. All right. Well, thank you for inviting us to talk at this interesting session. I'm Dean Kraushaar at the University of Richmond. My colleague Rob Dolan will tag team with me, and I'm going to start talking a little bit about theory and a few facts, and then he's going to follow up with even more facts, and we'll try to shed a little light on the issue of public investment and its benefits and costs. My disclosure is I spent half my career working at the Federal Reserve. The motto of the Federal Reserve is, when the party gets going, it's time to take the punch bowl away. So if my remarks seem a little dour, it's because I'm well trained in that aspect. So all economists start with theory, and the theory about public investment is very clear. First, you want to take a look at the benefits. And what are the benefits of public investment? They are, in principle, that public investment should be welfare enhancing. Your apple tastes better when you eat it in a public park. Your transportation network for business firms works better if the roads are in good condition. You can move goods more easily if train tracks are easily accessible and in good repair. So there are benefits to public investment that are important to recognize and understand. And we saw in the first paper today some examples of how public investment could be useful. There's an externality to the economy in the shape, in terms of reducing pollution using alternative fuels. It reduces dependence on foreign oil, and you might think that's also an externality that's worth tackling. Some of the biggest externalities that public investment solves are education. The benefits to having a well-educated populace are tremendous, and many studies of the impact of public investment on the economy highlight in particular the role of government investment on education infrastructure. We also should think about government capital as a complement to private capital, and the president talked about this not long ago, that, private sector capital works better when there's good public capital to go along with it. Business firms will invest more if there's good transportation systems, water systems, sewage systems, and so on. And so they kind of go hand in hand and typically are developed together. All right, so the benefits of public investment may be large theoretically, but it's important to also recognize the costs. We kind of know one of the main costs is that public investment is done by governments, and in some of the discussions so far, we've seen at least a hint of the potential for government waste and bureaucracy costs. There tends to be, because of the political system being imperfect, we tend to get inefficient spending, bridges to nowhere, things like that. That doesn't help us. That doesn't improve welfare because the benefits aren't worth the costs. Also, economists recognize that anytime you engage in public investment, you have to pay for it. And paying for it is costly. But not only that, but there's a marginal excess burden from taxation. When you impose taxes, that creates distortions. So the cost of $1 of public spending is more than $1's worth of tax revenue and the distorted costs from raising that revenue. So the real question that you face theoretically, and what justifies any public investment project, is, do the benefits exceed the costs? And you should not think that any government spending is going to improve welfare. Government spending that increases GDP won't necessarily increase welfare. It's got to be government investment that is productive and does something for society. If you pay people to dig holes and fill them in, that's not welfare enhancing. It's enhancing the welfare of the person who got paid to do something unproductive. But for society as a whole, we'd much rather identify projects that enhance welfare, that are productive, that complement private capital, and that serve the public well. So I'm going to talk a little bit about empirical analysis and then show you some data on what government investment and public investment in general look like. And then Rob's going to follow up with some more facts about that. In the research that economists have done on public investment, they often ignore the benefits, which doesn't make a lot of sense. But when you're just looking at time series of data, it's very easy to look at government spending going up and income going up at the same time and conclude that the one causes the other. Often the studies that are done look at the shift in aggregate demand caused by increased government spending, and they ignore issues of crowding out or the marginal excess burden of taxation and so on. If you look carefully at the literature, much of it finds huge multipliers from increasing government spending and investment, that if you increase government spending by $1 billion, you get $3 billion of increase in GDP. A lot of those, however, the causation isn't clear. Is it really the other way around, that as GDP was going up, we also did some public investment along the way, and that's really what's driving the result. The best work on the research front shows that the biggest payoffs are to education investment, that investing in schools, colleges, early childhood education, those have a really big payoff, and other government investment is not as productive. Some of the most controversial articles show that increasing government investment doesn't have much impact on GDP, and that's probably a combination of a lack of good cost-benefit analysis and some wasteful projects being included in those studies. Now, Paul raised the issue of the zero lower bound, and theoretically and empirically, at the zero lower bound, things are different. If government invests and spends more at the zero lower bound, then there's less crowding out and the multipliers can be much bigger. But as Mike Woodford shows theoretically in a recent article, the multipliers do depend on the state of the economy. They do depend on the response of monetary policy to the fiscal policy, but the spending needs to be done all completely while you're at the zero lower bound. If it takes too long to put it in place, then there's more crowding out and the multipliers go down. So there's also been a lot of work done on grants. One way that the federal government can encourage public investment is to provide grants to state and local governments. And in principle, that could work well, except that what then happens is many state and local governments just wait until they get a grant. They don't pay their fair share of the benefits to the state and local community. So it often leads to inefficiency in the amount of public investment that is done. Sometimes they just get the grants and pay off debt and they don't actually do any infrastructure beyond what they were going to do. So it's not easy to do it in the right way. All right, so let me show you some pictures just so everybody is clear on what has actually happened over time to the amount of public investment in the economy. And so here's the first graph I'm going to show you is the amount of gross government investment as a percent of GDP. And when you look at the amount of gross government investment as a percent of GDP from 1960 to 2012, you see there's little wiggles here and there, many related to the business cycle. But if you kind of look at the overall trend, you see that government gross investment as a percent of GDP was about 5% in the 1960s, fell to about 3.5% in much of the 1970s and 80s, and has been about 3% for the last 20 years. So it's not that we're not investing more or less than we used to, at least for the last 20 years. We certainly are investing less than we did in the 1960s. But of course, the nature of society may have changed. The types of investment projects may have changed. So really, it's hard to judge, are we investing enough or not enough now compared to before? So let's compare it to the private sector. What does private sector investment look like over this same period? And has there been the same fall from the 1960s when the economy was growing much more rapidly to today? So here's the same graph for the government. And then on the right scale, where the scale is about 10 times as big, I have gross private domestic investment as a percent of GDP for the private sector. So we've got government investment as a percent of GDP on the left scale, shown in blue, private sector investment as a share of GDP on the right scale, shown in red. And if you look at that, you might be convinced that government investment may be too large. That as a share of GDP, government investment fell a little bit from the 1960s, but private investment fell more. Again, that's probably not the right judgment to make. It was really just to show the comparison between the public sector and private sector, because the nature of the government capital goods may be very different from the private capital goods and so on. So, but just as a first approximation, you can't say government investment has fallen way behind private investment. You have to look more at the nature of the capital goods. So let's take a look at that. And when you look at that, let's take a look at the government capital stock. So let's take the Bureau of Economic Analysis's measure of the capital stock by the government, again, as a percent of GDP. And again, you see this downward sloping trend. So government capital as a percent of GDP was about 100% back in the 1960s and fell gradually to about 65% or so today. So again, that might worry you that the government's capital stock, that's roads and bridges and sewer systems and other transportation systems, has been declining. Again, let's compare to the private sector. What about private capital stock as a percent of GDP? And now in red, I'm showing the private sector capital stock as a percent of GDP. Again, the scales are different. The scale is about 2.5 times for the private sector as for the government sector. So don't look at the line in relation to the other one, but look at the overall movements of those lines. And what you'll see is that they've kind of moved roughly in line with each other, that, that both have declined somewhat over time. And although their paths have been somewhat different, the private capital stock as a percent of GDP has fallen about as much as the government capital stock as a percent of GDP. So that might convince you that there's a parallel between government investment and private investment, and at least overall, maybe that gives you some comfort that we haven't invested too little in public investment. So what an economist would argue is that any new public investment projects, whether they're related to alternative fuels or to additional educational infrastructure, needs to be justified on a cost-benefit basis. A priori, it's not obvious that we have too little or too much government investment and capital. Finally, though, to relate this to the second paper this morning that talked about private government debt, I'm going to show you the graph that worries me the most, which is I've looked at government capital. That's the assets that the government owns. Now let's look at government debt and subtract the debt from the capital and ask, what is the government's net worth? And that's my last graph that I'll show you. And this is government net worth as a percent of GDP. This one only goes back to 1970. In 1970, government net worth as a percent of GDP was about 50%. That means your share of government's net worth was actually positive. The government had assets that exceeded the outstanding value of the debt. But that has turned negative, and we're now at about a minus 20% government net worth as a percent of GDP, just counting current liabilities of the government and current assets of the government. And just to relate it to that second paper this morning, that should worry you about the government debt. This is kind of why we're worried about the government debt. People are worried, of course, about the private debt, as we saw earlier, but there is a positive net worth, and it's about $65 trillion positive net worth for households. So if you take households, the value of their assets, and subtract off the value of their debt, it's $65 trillion. That's about 4 times GDP. Government net worth is about negative 1/5 of GDP. Okay, so the bottom line of the facts is government capital, government investment have declined somewhat over time, as has private investment and private capital. Government net worth has become more negative. So now I'm going to turn it over to my colleague Rob Dolan, who's going to talk about more facts and the potential for crowding out.
When we were asked to prepare for this, we were instructed to talk about public investment in a liquidity trap. My comments are about this liquidity trap, and you're going to see that I think that's a pretty important distinction, because I probably would be a little more sanguine about the role of public investment in the liquidity trap, except for the circumstances which we face at this time. Secondly, I'm going to focus on the longer term. And in doing that, I have to rely on forecasts. I'm going to rely on the Congressional Budget Office. But a lot of what I'm going to refer to is maybe the peril of acting quickly for public investment at this time is going to depend on what we think growth rates and interest rates and things like that will be down the road. Now, I'm going to show you some slides, and I'm just going to provide a little bit of narrative. I think you'll pick up on the story pretty quickly. I think some aspects of the story you've seen. Then I'll give you my own sort of personal conclusions about a policy of aggressive public investment in this liquidity trap. And then I'm going to give you some reflections on what I think might be an alternative reaction in a fiscal sense. So that's kind of the blueprint here. I don't know if you can hear me. Could you hear me if I were out here or not? Fine. Okay, because I need to point. All right. So I also need my glasses. Well, if there isn't, I'll get even closer. All right, the first one is we know that there's going to be a recovery. We're not sure when, but we're hopeful there'll be a recovery. All I'm trying to show you in this slide are the forecasted reactions of the Federal Reserve. I'm basing this basically looking at history, and we can see that every time the Fed has decided to raise rates, they've been aggressive. Okay, they've increased quickly. We can certainly look at see that every time there's been a recovery, the Fed has moved quite aggressively. And we can see the CBO forecasts are certainly showing the same thing with regard to the 3-month Treasury bill. We can see that the 10-year Treasury bond is expected to go to roughly where it was before the decline. So we're going to base some of our estimates on future debt service based on these particular forecasts. And we're going to base it on the fact that we think the Fed's going to start increasing roughly 2015. Once they do, CBO is assuming that there will be a approaching our potential GDP in 2017. So these are some important dates. The ambidextrous. All right, the first slide I want to show you is simply a little historical perspective on the budget or surplus as a percent of GDP. And as you look at this, all I really like you to remember or reflect on is the fact that in the past, when we have come out and had reasonably good periods of growth, that we can see that at that particular time, the deficit as a percent of GDP was actually positive in these two periods. But the worst case was following the 1982 recession. And this particular deficit, of course, reflects back to the period when Ronald Reagan was raising defense due to Star Wars, and it also come up with the major Reagan tax cut. So the structural deficit had increased, and it increased at that point to about 2.5% of GDP. The first point that concerns me then is that based on CBO estimates, I want you to notice that after 2017, what do we see? Based on current spending policies, we're going to be looking at a steady state deficit at 3.8% of GDP. Now, if we have a steady state at 3.8% of GDP deficit, what does that imply, given our long-term growth rate, about the level of debt? Well, that's the next picture. Sorry. I don't know if I can have glasses and here's our story showing what's happened to debt held by the public. Okay. 73% of the debt is held by the public. You're asking, where's the rest of it? Well, it's in the Social Security Trust Fund. Agencies hold most of that debt. So 73% of it currently is held by the public. Forecasted to go to 77%. Okay? You can see that forecast of 77% is well beyond this period of recovery. And I want you to notice that we see this little staircase here. I find the staircase a little disconcerting. As we recover, what are we seeing? We're not seeing our debt positioning as a share of GDP stabilizing. We're seeing that it's going up. Now, I think probably some people can speculate where the story is going. We're going to talk about why it's going up. In essence, this is the significant part of our federal budget. Okay. These are our now famous entitlement programs. In addition to the entitlements, we've added interest expense. Now, I want you to focus on the pig and the snake right here. That pig and snake emerged during the Reagan administration. That was the largest structural deficit that we've had other than 4 years. Okay. It hit about 6% of GDP. And of course, that large structural deficit ended up in having some ramifications down the road for debt service. And you can see that, what's happening to our interest expense during this period. Now, I want you to look at this over here. I would describe that as an emerging pig in the intestine. That is our future debt service. Okay. In addition to that debt service, we certainly see the inexorable march of our entitlement programs. Okay. Now, in constructing this, I did take one entitlement program out. In income security, I took out unemployment compensation. It normally is in there, but I took it out because I didn't want to see this huge blip, which was temporary, given the severity of our most recent recession. So I think that's a fairly balanced presentation of the trends and those basic entitlement programs. So my general point would be that we can see that as a percent of GDP, what is happening, our fundamental entitlement plus debt service component of our deficit is not going away, it's getting worse. There's no news story there, but I hope you find the picture references interesting. All right, so now we're going to go ahead and say this is what's going to be going on in terms of the gross federal debt holdings. And the only reason I've got this one up here is I want you to focus on this range in here. And remember, that's the agency debt held by Social Security. I also want you to focus on this number. This is the share of our debt held by the public that is lent to us by the rest of the world. So if you do the math, you can see pretty quickly that 73% is about half of, 35% is about half of 73%. But in case you didn't want to do the math, I have another slide for you. 48% of our current debt held by the public is currently held by the rest of the world. And roughly half of that is held by China and Japan. Now, why do I worry a little bit about that? Because looking down the road, we're going to have to be borrowing increasingly. And my guess is if the trends continue, we'll be borrowing increasingly from the rest of the world. Now, do I have a concern about that? Maybe a little bit of a concern. Okay. I have an adage that I tell my students that it's better to have borrowed and invested than never to have invested. That's as literary as I get. But the bottom line is that you do have the debt service that you have to pay. Well, let's go ahead and let's borrow money. We're going to borrow money, but we're going to have economic growth. Now, part of the problem is a piece of the pie goes to the debt service. But this isn't a bad story. I think you can see the geometry here. The area that we enjoyed in terms of our improving standard of living is probably justified in what we pay to the government. Now, the point that's important to grasp here is that our standard of living went up, didn't it? But it didn't go up as much as it would have if we had borrowed the money from ourselves. But our national well-being is diminished compared to what it could have been. But we're still better off. 10% of nothing, something is better than 90% of nothing. Okay, well, let's go to the next slide. Suppose that we borrow money for public investment. And as Dean suggested, we're not real sure what the productivity of that public investment is. So maybe the pie doesn't get as big if we're not particularly confident what the returns are going to be. And then if the pie isn't as big, then what happens? You've borrowed more money. Your debt service has gone up, but now your debt service is coming out of your standard of living. Okay? So in this particular case, what's happened? Our standard of living as a nation has actually gone down. Now, I think this is a pretty important concept to grasp, a pretty straightforward concept. But if we are going to go out and borrow money, which is what the federal government would have to do, in order to counter this liquidity trap, we better be awfully sure, based on Dean's benefit cost discussions, we better be awfully sure about the true productivity of that investment. Because if it isn't truly productive, we end up with this picture. And that's something that concerns me. It concerns me as well because Dean brought up another term called marginal excess burden. I don't know if I'll believe it. And generally speaking, if you've already raised taxes and then you raise them again, the excess burden actually rises by the square of the increase. So there's a pretty heavy excess burden when you have additional increases in taxes. So if you're going to invest in public infrastructure, it better be pretty productive in order to justify that increase in excess burden. So in this particular case, I just have some qualms about the level of public investment that might be necessary, but more importantly, how we're going to fund it. Because if we didn't fund it internally, and we don't have great productivity improvements, this is the picture that I would suggest is relevant. All right, this is just another longer-term view. Notice this is the projected components in 2021, and we see the big two, healthcare and Social Security. I think this part of the big two is important because we have the Affordable Care Act that's just taking effect. The hope, and I'm among the hopeful, is that it will help us rein in healthcare costs. I think everybody here knows the 800-pound gorilla is healthcare costs. It's been a problem for decades. The problem doesn't appear to be going away, but hopefully the new act will give us a little bit of improvement. Now notice that healthcare has flattened out as a percentage of GDP. So if we could just get it rising at the rate of GDP, that would be a victory. Unfortunately, what do we see? We see that our victory might be short-lived because, once again, at the end, we can see that healthcare spending is likely to go up. Now, that's not the blame of whether Affordable Care Act works or not. That's the demographics. That's appalling. So as that goes, now Social Security, it's increasing, but it's not dramatic, but it is inexorable. It's going to But this is the one that concerns me. Notice what the interest payments as a percent of GDP do. And we know why this is the case. We have a growing debt, and during the recovery, we know where short and long-term interest rates are going. So we have two factors behind that. But I'm going to throw a little additional cold water on this. Remember I mentioned the Social Security Trust Fund? I think everyone in the room is aware that we had a payroll tax holiday for 2 years. That payroll tax holiday and Social Security basically moved Social Security's insolvency date forward from 2036 to 2033. Now, to show you how old I am, 10 years ago, I remember when the insolvency date was 2042. In 9 years, what's happened to that insolvency date? It's moved, excuse me, in 10 years, it's moved 9 years. Why am I a little pessimistic? If you'd asked me 10 years ago if I thought the solvency of Social Security would have changed by 9 years, I would have said not in your life. Okay. So I'm not terribly sanguine about the degree of what's called cost control in these programs. Well, now in 2020, what's going to happen? Social Security isn't a matter of the year 2033. It's in the 2020s. Because Social Security suddenly is going to have to start selling assets. And when they start selling assets, what is that going to do to interest rates? That's going to be further congestion, further possibility for crowding out. I hate to bring that term up. I don't think we'll have crowding out right now. I'm worried about what's going to happen down the road. Now, I know you can say, oh, that's a cop-out. Perhaps Keynes would say, if you're in a hurricane in a rowboat, don't tell me the hurricane's going to settle down in 3 years. I want some help now. Okay? Well, if you're that person in the rowboat, you don't want to be listening to me. Okay? I'm more concerned about when the hurricane clears, I want to make sure it's clear for a long time. So that's my notion of focusing more on the longer term. All right, this one I think is a pretty interesting slide. Sidebar to this. Dean and I came up with this slide completely independently. I can't even show you this. I said, Dean, this is one of my favorite slides as well. But here's the reason it's one of my favorites. We basically have our revenue less interest. So you can sort of think about it. Is that your household cash flow? Well, you paid your mortgage off. You paid your, not off, but you made your mortgage payment. What do you have left over? Well, I've got my revenues after I made my mortgage payment. We've got mandatory spending. That's where our friends entitlements are. We have our discretionary spending, and we have our budget deficit. And what is interesting about this picture, I think, is that basically what is this saying? We have gradually moved to a situation where what is true? Our revenue, once we take care of our debt service, basically covers our mandatory spending, the vast share of which is entitlements programs over which we have established no clear controls. Okay? So now, if you look at this, it's kind of interesting. What does this comparison tell you? It tells me that any discretionary spending is basically coming from where? You're borrowing almost every dollar. So if we're going to do public investment in this environment, what is that a harbinger for in terms of where the money's coming from? It's dollar for dollar being borrowed. Now, that could be a downward spiral. Why? Because we know that interest rates are going up, and I've already shown you the emerging pig in the next snake. Right? Excuse me, the next pig in the snake. So, go ahead. What are we doing on this alternative? I mentioned, this is a similar chart to before, but the difference here is this is, before it was a percent of GDP. This is a percent of overall spending. And now if we're going to start spending on things like public investment, even if it was productive, we have to emphasize that basically, here's other up here. Other includes spending on public investment. So I'm a little uncomfortable with the implications. Now, I'm not completely down on public investment, and I took this from the CNN Money page, and I forgot to put the source. So I didn't know this entirely. But public investment brought you the internet, the microchip, the GPS system, and barcode. And I would suggest that those are pretty significant advances, unless you don't like being spied upon by anyone who wants to on the internet in terms of your premises. I was sort of astonished at whether there's any privacy rights to this or not. But those are pretty major innovations. But my point is, these were not necessarily purposeful. It's the Defense Department. It's the space program. Okay? So if you're saying, I'm going to go spend on public investment, boy, I know there's going to be a great rate of return. The fact of the matter is, I'm not so sure we know what the rate of return is on these projects. So maybe it's a wing and a prayer, I don't know. But can you afford to take that risk in this particular environment? That said, I have to bring up the next. I thought I was doing pretty well, but I can see I'm last. The famous quote. Okay, this was actually in a New York Times interview. President subsequently made it in the news conference. But I think we have to be careful because I agree. My neighborhood has more potholes than anywhere else in Richmond. I know that sounds like I'm whining, it may be hyperbole, but I have a lot of potholes in my neighborhood. I'd love to see some infrastructural repair. That said, we don't need 6 people filling the potholes. You catch my drift. So, in some sense, I'm going back to how much productivity are we really going to get. I'm not going to read this to you. I hope you can read it. I'm going to give you a moment to read it. And then afterwards, I'm going to say a little bit more. How's my time here? All right. This is from the most recent economic analysis by the Congressional Budget Office of the American Recovery and Reinvestment Act, the 2009 Act, which was basically $862 million. About a fifth of that, you could suggest, was oriented towards infrastructure. I think this captures my ambivalence pretty well. When I get down here, I say, boy, this is a great story. I want to be part of it. The idea that not only can public investment raise productivity, but maybe it creates incentives for increased private investment. The problem is I don't know entirely if that's true. I am a little bit more comfortable with the facts up there. So it's kind of like the realism in me focuses on this. The optimist in me focuses on this. And it's a matter of, am I really willing to kind of roll the dice on this when I look at the potential longer-term downsides? Okay, so I want to say again that I think my concerns about big public spending in this liquidity trap is that we basically are moving from a position of, I think I'll say, unprecedented fiscal weakness. And moving from that fiscal weakness, I think we will only move into greater fiscal weakness. And so in that context, I don't think the risk is worth the likely return. Now, I think that's a hollow conclusion if I can't come up with something a little better. But right now, I feel like our situation is, as far as public investment, is a little bit like a bad marriage. I've got lots of metaphors. I'm not sure which one to use, but I'm going to start with bad marriage. You have a bad marriage, so what do? You say, well, maybe if we make an investment in something important, it'll work out. So what do? You have a baby. You buy a house. Okay. And then it doesn't work out, and things are worse, aren't they? Well, we do have a bad marriage. It's between revenue and expenditure. And until we resolve that, I think we're really heading for a divorce court. Okay. My other analogy is that basically we're in for a fiscal train wreck. And if you're in for a fiscal train wreck, you don't add more cars to the train. Now, someone could say, oh no, we don't want to, we need just new, in terms of infrastructure, we need to just build better, we need to build better train tracks. Okay. Now, if you don't change the direction you're heading, better train tracks just get you to the train wreck faster. So it's very important that we change the direction of our fiscal policy, and I think that direction has to be something that's much more responsible in terms of revenues and expenditures. Now, my response to this in terms of quote solution or just something that I think we need to move toward, is that maybe if we had a little more fiscal responsibility, we'd have a little less uncertainty. We've been mentioning the liquidity trap. I think to a significant extent, firms that are flush with cash, they are drowning in a pool of uncertainty. So I believe that if we could clear up some of the fiscal uncertainty, that maybe we wouldn't be drowning, and that maybe we would begin to move a little more swiftly out of this obvious prolonged delay. I don't question that we are under a liquidity trap. I just don't think we have the fiscal strength at this time to move out of it aggressively with further public spending.